Hello and welcome to this new video. In this 3.5 hours of video, you are going to master the preparation of financial statements. Starting right from the trial balance, we will prepare profit and loss statement, balance sheet, cash flow statement, statement of changes in equity, and notes to the financial statements. So we will start with one single year of 2019 and we will be preparing all these reports one by one. And once you start to understand the principle, you will have the data for 2020 and 2021 with answers and explanations where you will be able to practice all of these skills yourself. And once we have mastered all the basics, we will be learning that how we can compile all this information in one beautiful Excel file where we have all this information side by side, where we have profit and loss statement, balance sheet, cash flow statement, and statement of changes in equity and notes for all these different financial years. And with Excel, we will be learning that how we can automate the process of these reports, especially the cash flow statements. But we will not simply dive into the Excel file and start preparing these figures. Rather, I would start with the very basic lectures where I would be explaining you that what are financial statements, what are the components of financial statements. I would be explaining you the financial statements at its simplest, that what this report stands for, what is the overall meaning, and explaining all those financial terms one by one. I would be showing you the reports at their finest. So the reports that you practically see for all those big companies, you will be able to understand that step by step. And after that, I would be explaining you the fundamental concepts behind these reports, and then I would be explaining you that how these reports are being built on those fundamental concepts. And then I would also be explaining you all those accounting, the basics of accounting that are behind these financial statements, so that you can understand these concepts better. While preparing cash flow statements, we will be working step by step. So for example, we will not be diving into the profit and loss statement and the balance sheet altogether. We will be working with very small extracts of them and building the concept first. And then once we have the concepts, once we have the fundamentals, we will be going to those big Excel files and preparing all of that. So this is going to be an amazing journey, and I promise that in the next 3.5 hours, you will be able to master the preparation of financial statements. So let's dive in. To analyze any business, that how well a business is doing, we need to see its business reports. Now there will be thousands of business reports covering different aspects of the business like marketing and sales and distribution and manufacturing. But out of these reports, the reports that focus on the financial aspects of the business, I mean that tell you about income and expenses and profitability and other financial aspects, these reports are called financial reports. Now depending on the size of the business, there can be hundreds of financial reports, some of which are focused at day-to-day level details for the employees, and some of which are focused on the overall summarized details, summarized picture of the business. So we pick up the key financial reports out of these and we draft a set that fully, legally, and briefly summarize all the key financial aspects of the business, and these statements are called financial statements. So I repeat, fully, briefly, and legally summarize. By summarize, I mean that this is going to give you an overall picture of the company. By fully, we mean that this is going to cover all the financial aspects. And by legally, we mean to say that these reports are drafted as per the requirements of law. So more about that in a minute, but first let us take a look at which reports are a part of financial statements. So first of all, there is going to be a profit and loss statement. What is that and what does that covers? We are going to discuss that in a few minutes. But first, let Let me list down all the reports that are covered here. So after the profit and loss statement, we have the balance sheet, and we have cash flow statement, and we have a statement of changes in equity, and finally we have one last part in the financial statements, that is notes to the financial statements. So this area basically provides the additional details for all the values that appear in the four different reports above. So after these financial reports, let me tell you one more detail here, and that is the first three of these are the most important, and these are also often referred to as the three statements. So now before we start discussing all of these reports one by one, I would like to tell you the importance of these set of financial reports, financial statements, once more time. And that is, first of all, we have to know one thing, and that is this is going to be the financial summary of all the business aspects. So nothing is going to be missed. So if you are looking at the financial statements of any business, you are going to get a full summary of all the financial aspects that you need for your decision making. Point number two, the standard and universal formats are going to be followed, and similarly the contents of these reports are going to be standard and universal. And what I mean by that is, if you are analyzing a company that is in the USA or in the Germany or France or any other country from Asia or Africa, the standard format will be followed, and you will not be finding any strange format of these reports. And finally, these reports must be prepared by all the organizations. So if you decide to analyze a company, let us say Apple or Google or Microsoft or any company from the Middle East, these reports will be and must be prepared by all of these organizations, so you can pick up and analyze any of them. Well, the only exception to all of these will be all the organizations is if you have a private business that has no borrowing whatsoever and no investment at all. In that case, there is an exception that you may choose not to prepare these statements, or you can simply say that only prepare the very simple statements that are required by the government, and that formats can be very simple. So that is the only exception for the privately owned businesses, but for all other organizations, these reports must be prepared. Now we would go back and start analyzing these reports, start looking at these reports one by one. Now that we have an introduction of the financial statements, let us talk about its first component in detail, and that is the profit and loss statement. So the profit and loss statement in summary summarizes all the revenues and expenses of the business. With revenue, we mean the money that the business generates, and with expenses, we mean the money that the business spends. So if you are spending money on anything, that will be called expenses, and if you are receiving money, if you are generating money from anything, that will be called revenue. So a summary of these two will be called profit and loss statement. And if I show you the complete format, this is how the report will be structured. On the top, you will have the company name and the report heading and the time for which it is prepared. For the period, it can be a month or a quarter or a year or even a single day or a week. So in this report, on the top, you will be seeing all of your revenues. Then you will represent all the expenses. You will deduct the expenses from the revenue, and revenue minus expenses will be your profit. One thing that we must keep in mind is that revenue is sometimes also called sales, especially in the manufacturing and trading companies. So we can say that sales minus expenses is our profit. So now you will understand the two key terms, revenue and profit. So revenue is the money that you receive from your customers, and once you deduct all of the expenses, then the money that is left over to you is called profit. And definitely if the expenses are more than the revenue, then this is going to be a loss. Now we have to bring in some additional details here in this report, and that has more to do with the type of revenue and the type of expenses. So basically our next mission here is to make this report more meaningful and let the readers of the report know more about their revenues and expenses and the profitability. And for that we will need to classify our revenues and expenses into different categories. So now that we have an overview of the income and expenses, we now need to classify the income and expenses into different categories so that anyone who is looking at reports is going to get a more detailed view about the business. And the first classification that we are going to do is operating and non-operating. And this is going to be very simple. The operating income and expenses are those which relates to the core business activities. And obviously, then non-operating will be the ones which do not relate to the core business activities. And what does that mean? Let me explain you. So let us say we are going to talk about a restaurant. We have a business that is a restaurant, and in that restaurant we sell food and drinks to our customers. So any revenue that we collect from our customers by selling them food or drinks, that will be classified as operating. And if there happen to be any other type of revenue, any other type of money coming in, that will be non-operating. And same goes for the expenses, but let us talk about both of them, income and expenses, in the classes of operating and non-operating in a bit more detail, because that is going to be very relevant to us. So the first of all, we know revenue is the money generated by the business, and we classify that into operating and non-operating. And in that operating, I mean that is related to the core business activity, we have sale of goods or fees for the services. So if a law firm is receiving fees for their services, that will also be classified as operating revenue. So I hope that is very clear to you. Another example of this would be, a university that is collecting revenue from its students for the fees of its tuitions. That is going to be the operating revenue for them. But what is going to be non-operating then? Let me explain that to you. So let us say we have some extra cash. We are still a restaurant, but we have some extra cash that we have compiled up. So what we will do is that we will keep that cash into our bank, and bank will be paying us interest over our cash balance. So this revenue, this money that we generate, will be not related to our core business activity, that is the restaurant thing, the selling of food or drinks. So this revenue will be classified as non-operating revenue. Similarly, if I give you this example here, that is dividend income. So if you don't know about dividend, let me explain that to you first. So when we invest in a company, and at the end of the year or within the year, the company distributes a part of its profit, and this distributed profit is called dividend. Now in this case, let us go back to our example, and we were saying that we are a restaurant. So a restaurant they had some extra cash, and that extra cash they invested that into another company, and the other company distributed their profit, and that was dividend income for us. Because we had made the investment, we will receive this profit from them, and that will be the dividend income. Now for that restaurant, or even for that university, or even for that law firm, this income is not related to their core business activity, so that is going to be called non-operating revenue. So if I talk about this gain on the sale of asset now, let me explain that to you. Let us say we had some old plant and machinery that is no more useful for the company, and we decided to sell that. When we sold that, we generated money on that sale, and that sale, eventually that is not our business. So that old plant and machinery, for example, say for the restaurant, that old plant and machinery, the previous equipment that we were using, is no more useful, so we are selling that. That is going to be non-operating, because the selling of equipment is not our business. Our business is selling of food and drinks. So this is again going to be non-operating revenue. And finally, let us talk about this exchange gain as well. So let us say we made some sale to a British company for which we need to receive £1 million in 3 months' time. So based on our transaction terms, the payment is to be received in 3 months' time. And we are supposed to receive £1 million. Now we are a US based company, and for us the £1 million is equivalent to 2.5 million US dollars today. So we booked this transaction in our books for $2.5 million. But after 3 months, when we eventually received the payment, when we actually received the £1 million from the British company, that is now converted to 3 million US dollars. So there is a gain of $500,000 because of the exchange rate movement. This gain is called exchange gain, and this has occurred to us. We have earned this money, but this is not because of our operations. This is just because of the exchange rate movement. So we need to classify that as non-operating revenue. Now you must be making a sense why we are separating the operating and non-operating. So operational revenue is the one that we are generating with the efficiency of our business, with the quality of our product or service, or with our hard work, right? But non-operating revenue is the one that is just happening to us. So any reader of our reports must know that what money is coming from our operations and what money is coming in just because of the incidental activities happening around our business. So this is our first classification. Now, just like the revenue, we also need to classify our expenses into operating and non-operating, and let's do that in the next lecture. Now, just like the revenue, we also need to classify the expenses into operational and non-operational expenses. And the main definition is going to be same. Operational expenses relate to the main business activities, whereas the non-operational expenses relate to other areas that are other expenses that are incurred other than the main business activity. Of course, we need to take some examples to understand that in full detail. So first of all, if you are selling goods as it is, I mean you just purchase the goods from one market and sell that to another. By the way, this business is called trading business. The cost of the goods that you purchase are going to be called the operational expenses. By the way, please keep in mind, we will only use the word goods for the items that are purchased for the purpose of resale. Now, if you are manufacturing your stuff to sell, that will be, you will need the raw materials, and you will also need the cost of manufacturing, I mean the labor and the factory and the utilities. And you will also need to, once you have purchased your raw materials or goods, you will also need to bring in to your factory or to the point of sale. So all of these expenses are incurred on the product itself. So these are going to be definitely classified as operating expenses. But just by making the goods or just by purchasing the goods, you can't really sell them. You have to build a complete ecosystem to enable this business, and for that you will need to incur the marketing expenses and the general administration, and then you will also need the warehousing and storage, and finally shipping and handling. So all of these expenses combined together, all of these activities combined together brings a complete business to its motion. So these all expenses are going to be classified as operating expenses. But on the other hand, there are some expenses which are not related to the business itself. And the example are going to be, first of all, let us talk about this interest expense. So let us say for your business, you have to borrow the money. You don't have money to support the full business activity, and for that you have borrowed some money from the bank. So you have to pay interest over this money, and this interest expense is going to be classified as non-operating activity, because eventually this is because of the financing structure of the company rather than the business itself. What that means is, if you had the money yourself from the owners of the business, you must not have spent this money, right, on interest. So we say that this is non-operational. Similarly, if we talk about tax, tax has more to do with the government laws and the country in which you are operating, and less to do with the business efficiency itself. So we also classify that into non-operating activity. We just spoke about the gain on the sale of asset. Similarly, sometimes there can be loss on the sale of asset, where let us say we purchase an asset for $1 million and we have to sell the asset for less than that. But selling off this asset is not our business. Our business is something different. It was just our plant and machinery that was being used, and now we are throwing it away. So we sold that. So that revenue is going to be classified as non-operating because that is not the main business. And finally, exchange loss. We just spoke about exchange gain a moment ago. Exchange loss is opposite to that. In this case, I had to pay you $1 million, but because the exchange rate has moved, I have to pay you some extra, let us say $1.2 million now. So this extra $0.2 million payment that I just had to pay you because of the market fluctuation of the exchange rate, this will be called non-operating. So the original $1 million cost of the business is going to be falling here in the operational, but this extra 0.2 will be classified here into the non-operating expenses. Now I would again repeat one thing, and that is this classification is important for the readers of the report so that they know what expenses are being incurred on the business itself and what are just incidental to the business. So now that we understand operating expenses, non-operating expenses, and operating and non-operating revenue, we are now ready to prepare the complete profit and loss statement one more time, and let us do that in the next lecture. Welcome back. So we have already seen our profit and loss statement, and it was revenue minus expenses equals profit. But now that we understand the revenue and expenses in more detail, we are going to prepare our profit and loss statement in a bit more detail. This is not going to be the final format. We still need to work on that, but still we are going to understand a lot of different terms here. So first of all, let us go to the new format here, and this is going to be again from the top. This is going to be the same, the company name and the report title and the period that this is going to cover. And then you will notice that this time I'm going to cover 3 periods rather than the one: the financial year 2021, financial year 2020, and financial year 2019. Just for a moment, I will stop here and I will tell you about financial year. The calendar year starts from the 1st of January and it ends at the 31st of December. For the businesses, you can choose to work with any 12-year period for your reporting, and that 12-month period, 12-month period for the reporting, and that 12-month period is called financial year. So for example, I can decide for my business that my financial year will start from the 1st of July, and counting the next 12 months, it will end at the 30th of June next year. So this way I can decide my own financial year as well. Not really I can decide, it actually depends from country to country. Most of the countries have different financial year, and then in that country almost all the companies are going to follow the same financial year. But the key to notice here is it would be a 12-month period, which can be different from the calendar year itself. Now why I am going to show you 3 calendar years here? Well, when we spoke about financial statements, I told you one thing, and that is we have to prepare these reports according to the legal requirements. And one of the legal requirement is that we have to present the 2 previous periods for each period that we are going to show. So for example, if I am going to show you the report for financial year 2021, I am also obliged to present the values of 2020 and 2019 on the same report. Now let us come to the point that we are talking about here, and that is the overall report layout. So in this report, first of all, you will be classifying this report into operating and non-operating. The operating, that is going to be the core business activity. So on the top you will have the revenue, and of course this is going to fall in the operating area. So it means that this revenue is only the operating revenue of the business. Then we will deduct all the operating expenses like marketing and sales and distribution. And once we do that, once we deduct all these expenses, we will reach at the operating profit of the business. So you can say this is the profit that is coming from the core business activity. So anyone who is going to analyze the core business activity, this is the profit that they need to see. But nevertheless, there are some other income and expenses as well, and this report will show that as well. So we have non-operating income and expenses that can be interest income, gain or loss, exchange gain or loss, and other things like that. And once we have adjusted all this income and expense in this report as well, we will reach at profit before interest and tax. That is PBIT, profit before interest and tax. By the way, in many countries this is also called EBIT, that is earnings before interest and tax, but both of them refer to the same thing. After the PBIT, we will also deduct our interest expense to reach at profit before tax, and finally we deduct the tax as well, and that is the net profit. Now why we are calculating so many values here? It is very simple. Sometimes you need to ignore the taxation to look at the overall profitability. So you need to work on profit before tax. Sometimes for your business analysis, you would also say that I don't need to look at the financing structure or interest expenses. So I will be ignoring this as well, and I will be working on PBIT only. And sometimes you would say that I'm only looking at the core business area, so I will be focusing on the operating profit as well. So this all depends on the needs of the manager or the stakeholder who is looking at the report and the purpose he is looking this report for. But this is the overall structure. But here we have to bring in some additional details in the operating area. So what next we are going to do is we are going to further classify this operating account into two classes, and we are going to then finally reach at the final format for our profit and loss statement. But let us do that in the next lecture. Welcome back. So we have already discussed the expenses and we have classified them into operating and non-operating. Now for even more comprehensive reporting, we would further classify our operating expenses into the two, and the basis on which we are going to do that is, if you look at these expenses, the cost of goods purchased, or the cost of raw materials, or the cost of manufacturing itself, or the carriage that has been incurred to bring all that together, all of these expenses are the ones which are incurred on the product itself. On the other hand, if you look at these expenses which are marketing, administration, these expenses are also incurred for the purposes of business, but they are separate from the main product or service. So what we do is we classify this into the two, and we say that operating expenses are further split into trading and other operating. With trading, we will only talk about the expenses which are incurred on the product or service itself, whereas other operating expenses are going to be all of the other expenses which are incurred for business but other than the product itself. One very important point that we must keep in mind here is that trading expenses are usually referred to as cost of sales, and in case of manufacturing and trading organizations, this is also referred to as cost of goods sold. Now we have split our operating expenses into trading and other operating. We can do the same for the revenue as well, even though it will not be very meaningful there, but if we have to do it, let us see how we can. So for our revenue, we can say that the revenue that is coming from the product or service itself is trading revenue, and if there is any other business related revenue, operations related revenue, which is not from the product or service itself, that will be classified as other operating revenue. By the way, there is no other thing as other operating revenue, so any trading revenue by default falls under the operating revenue. So this classification will not be, this further classification will not be very meaningful here, and you can simply say operating revenue as your trading revenue as well. Now that we have this complete classification of operating expenses and operating revenue, we are now ready to take a look at our complete profit and loss statement format, and let us do that in the next lecture. Welcome back. So we have already seen this profit and loss statement where we have revenue, operating profit, PBIT, profit before tax, tax and net profit. So we already have seen this format. Now we know that we can further split our operating expenses and income into the trading and other operating. And for the trading part, the only expenses that we need to consider is the product cost itself, that is also called cost of sales. So the upper part of the P&L is going to be revenue minus cost of sales, and this calculation here, the net value here, will be called the gross profit. So now you know the term gross profit, and you know which profit figure to be used if you just have to look at the product profitability only. And if you have to look at the overall profitability of the business, of the operations, you will be talking about operating profit. And if you have to talk about the complete profitability of the venture, you will be looking at the net profit. Now this is almost final format of the profit and loss statement, with just one addition that will be coming later on. And this addition will be the depreciation and amortization expenses. Now what these expenses are and why they have to be talked about separately, we are going to discuss that later in this course. But for now, I just need to tell you one thing, and that is, when we have these expenses separately presented on the balance sheet, we will be calculating a subtotal before these expenses, and that subtotal will be called EBITDA, that is earnings before interest, tax and depreciation. Now this is the final format of the profit and loss statement that we are going to use. Up next, we are moving towards the other reports in the financial statements. So we have seen the profitability of a business in the previous financial statement that we have just discussed, which was profit and loss statement. Now we have to talk about the net wealth of the business. And for that, first of all, we have to understand what we mean by net wealth. For this, let us take an example, and this is John here, and John owns this beautiful car which is worth $1 million. Now the question is, does that mean John is worth $1 million today? Well, actually we have to see the full picture, and for full picture I just informed you about the additional information, and that is John has borrowed $1 million to buy this sports car. Now if you net off these two, he owns a car of $1 million, but then there is an obligation on him to pay back $1 million. If we net off these two, we can see that the net wealth of the John today is $0. Hence we conclude that when we see the net wealth of anyone, we doesn't just see what he owns, but we also have to see what they owe towards others. And when two of them are netted together, own versus owe is netted together, we reach at the net wealth of anyone. Now with this concept in mind, we are ready to start discussing our next financial statement, that is balance sheet. Let us do that in the next lecture. Now let us talk about the second report in the financial statements, and that is the balance sheet. So in the balance sheet, it basically summarizes all the wealth of the business. You can say it shows the net wealth of the business. And if we start about the report format, it starts with the same format that we have used for the profit and loss statement. On the top we have the company name, followed by the report title, that is balance sheet, and then we have the period that it covers. Now please keep in mind one thing, that this balance sheet is prepared as at a specific date. So the wealth is shown for a specific date, as at a specific date. For the profit and loss statement, we used for the period, but for the balance sheet we use as at, because all the wealth is always calculated at a particular date. Now in the wealth, first of all we will cover everything that the business owns. This will include multiple lines, one for each category. So for example, if you own properties, that will be shown separately here. If you own motor cars, that will be shown in the separate line. And then if you have plant and machinery, that will also be shown as separate line. So this way we will present all the major things that you own in separate lines, and everything you own will be calculated. But on the other hand, as we have just discussed in the previous lecture, that when we talk about wealth, we also have to talk about all the obligations that you have. So we will also present everything that you owe towards others, and again in separate lines for all the key obligations. So for example, for credit cards you will have a separate line, for the bank loans you will have a separate line. Similarly, if you have some other type of loan, like you have loan from the public, that will also be shown as a separate line. And then eventually we will net off these two, own minus O, and hence we will calculate the net wealth of the business. Now here we have to keep in mind one important thing, and that is this net wealth of the business is actually the wealth that the business has towards its owners. Business owes this wealth to its owners, and this is called equity capital. Now what does that mean? Let me explain you. So basically all of these reports, all of these financial reports are prepared using the accounting. So accounting is the engine behind all of this recording of expenses, income and all other things. And in accounting we follow one very important concept, and that concept is separate entity concept, which means that for the purposes of accounting and all of this financial reporting, the owner of the business is a separate entity from the business itself. And what that means is whatever the money has into the business from its owners, whatever the money is available in the business towards its owner, this is an obligation on the business to its owners. And using this concept we would say that, now come back to the balance sheet, now you can understand that everything that the business owns minus everything that the business owes towards others, we reach at the net wealth of the business that the business has, but that is the wealth that the business owes to its owners, and it is called equity capital. Now using the same concept we will just redefine this balance sheet, and we would say balance sheet equals everything you own equals everything you owe. Now that O can be owes to the external world, that can be the loans or debts you can say, and everything that is remaining will be owes towards the owners. So we have simplified that the own in the balance sheet will be equal to O, some will be obligations to the third party, and the remaining will be towards the owners of the business. And you can also say this owes towards the owner is the net wealth of the business. What we are going to do next is we are going to talk about this own and owe in detail, and we are going to use a proper terminology that is being used on the financial statements that are basically accounting terminologies. We have to learn that, and we are going to do that in the next lecture. So now that we understand the fundamental structure of balance sheet, let us learn the professional financial terminology that is being used on the professional balance sheets of the companies. First of all, let us talk about the own side. So everything that you own, we have a professional term for that is coming from accounting, and this term is assets. So what are assets? Assets are the valuables that are owned by a business. Now for the sake of better understanding and better presentation, we further classify our assets into two classes: current assets and non-current assets. So current assets are basically the assets where you reap the benefits from those assets within 1 year. And on the other side, for non-current assets, the benefit will be even after 1 year. So we can say that benefit is going to be 5 years or 10 years, but the basic definition is if the benefit is greater than 1 year, we would classify that as asset as non-current assets. Let us take some examples. So for example, if we talk about the current assets, the inventory is the basic example here. So inventory is supposed to be sold within a few days or maximum within a few months. So we would say that benefits are less than 1 year for this inventory. So we classify that as current assets. Similarly, receivables. So receivables are basically the people from which you need to receive your money. So for example, we sold you some goods or services on credit where we have provided you the goods or services, but the payment is to be received after 30 days or let us say 60 days. In that case, we will be calling you our receivable. So since the receivables are supposed to be converting to cash within a few days or months, we also classify them as current assets. Similarly, prepayments are the short-term advance payments. The most common example of that would be insurance, where we pay for a few months or for the complete year for insurance, and we call that our prepayment. So again, the benefit is going to be less than 1 year. And finally, cash and cash equivalents. With cash equivalents, we mean anything that can be easily quickly converted to cash. So for example, if you have gold coins, those can be easily quickly converted to cash, so we call them cash equivalents. So these are also supposed to be our current assets. On the other hand, we have non-current assets where we have plant and machinery. Of course, this is going to be beneficial for a larger span of multiple years, so we call that non-current. Similarly, land and buildings, motor vehicles, and patents and trademarks. So patents and trademarks are basically, we call them intangible assets. Why intangible? Because there is no physical substance like plant and machinery or land or building. There is a physical substance. But with patents and trademarks, this is something that gives us the legal right to own something like a formula or a brand name or something like that. So we call that intangible asset. But again, this is supposed to be beneficial for us in the long term, so we classify that as our non-current asset. So I summarize, everything that the business owns will be called asset, and we further classify that into current and non-current. Current where benefit is less than 1 year, non-current where benefit is more than 1 year. And finally, we also just learned one term, that is tangible and intangible. Tangible, where you have the physical substance, you can touch and see that asset, and intangible, where there is no physical substance but there is a legal right or something that is beneficial for you, for your company. Now after the own side, let us talk about the O side as well. But before that, I just forgot to mention one thing, and that is non-current assets are also called fixed assets. Now after the own, let us talk about the O side. So O, where we owe the money towards others, you can say these are the obligations. So there can be two classes here. The first one is owe to the third parties. Our business owe the money to the banks or to the other lenders who have given us the money on loan terms. All of that is falling here in this bracket of owe to the third parties. And then there is owe to the owners. And we just discussed that a few moments ago, that there is a separate entity concept that is being used in financial reporting, and that concept is, for the purposes of financial reporting, the owner of the business is a separate entity, which means that if there is owner's money invested into the business, that will be treated also as a liability, something like a business owed towards the owners. So we have professional terminologies for both of these sides. If we owe the money to the third parties, we call that liabilities, and if we owe the money to the owners of the business, we call that equity. or it is also sometimes called owner's equity, but we can simply say in short that is equity. Now on the liability side, we have a further classification just like assets, and that is current liabilities and non-current liabilities. The current liabilities are the ones where you have to settle the liability. I mean, you have to pay the money back within 1 year. And if the payment is due after 1 year, that is going to be falling under this non-current liabilities section. Now you can see, if I just give you an example, if we have a bank loan that is due after 5 years, you will classify that as non-current liabilities. But if you have a bank loan that is due within 3 months, just like our credit cards, we have to pay within a month or something, so we classify that our current liability. And now you can understand with all of these terminologies that anyone who is looking at the balance sheet will now be getting a more comprehensive view of the financial position of the business rather than just a simple overview. So keeping all this professional terminology in mind, let us redefine our balance sheet in the next lecture. So this is the balance sheet that we have discussed earlier in this section. So on the one side we have everything that we own, and on the other side we have everything that we owe, either to the external world or to the owners of the business. And we also discussed a very important point, that these two sides are equal to each other. Now all we need to do is to add the professional terminologies into our balance sheet, and rather than saying we own, we would say this is the asset side and these are all the assets of the business, and then the other side is liabilities and owner's equity side, where we show all the obligations, and of course these two sides are equivalent to each other. Now this is the final structure with one further addition, and that addition will be further split of assets into current and non-current, and same goes for the liabilities. So my final structure of the balance sheet that we would professionally see on all the companies' balance sheet is this one, where we have assets further split into current and non-current, and then we have total of the assets, and the other side of the balance sheet is split into current liabilities, and then we have non-current liabilities, and then we have owner's equity, and at the end of that we have the total of total liabilities and equity. And one last thing that we must mention again is these two sides are equal to each other. So now that we know the balance sheet, we are ready to move to the next parts of the financial statements. The next thing that we need to do is to understand equity in detail. And the simplest definition of equity will be the owner's money in business, or a better definition can be the money a business owes to its owners. In short, we also refer equity as owner's capital. So capital is basically the money invested into the business, and with this equity we particularly refer to the owner's money invested in business. Now how do we practically calculate equity in a business? First of all, we begin with the initial investment by the owner, and then we add any further investment that is made by the owner into the business. We deduct any withdrawals that is made by the owner from the business for his personal usage. By the way, we call withdrawals drawings, as you know in professional finance terminology. Withdrawals of the capital by the owner are referred to as drawings. After that, we would say all the profits that has been made by the business also eventually relates to the owners of the business. So profits are also added in the equity, and of course if the profits are distributed among the owners of the business, that will be deducted from this equity, because if the profits have been added and they are later distributed, they have to be deducted from the equity. By the way, the distributed profits are referred to as dividends. So this way we are going to calculate the equity. Of course, if there are losses in place of profits, they are going to be deducted from the equity as well. So this is a basic way to calculate equity. I repeat, initial investment plus any further investment minus any withdrawals that are made by the owner plus any profits that are earned by the owners by the business, and finally, if the profits are distributed, they have to be deducted from here. Now there will be some differences in the way we represent equity in our reports based on how your organization is registered. How will that impact and what we are talking about? Let us discuss that in the next lecture. So let us begin by understanding an organization. So any activity, any purpose-driven activity can be referred to as an organization. This is just a simple term of English, and you can use that without any further, classification. But now when you start a business, that is definitely an organization, but you need to register that business with the government. And for that purpose, you can actually use multiple structures. The first option with you is sole proprietorship, and with sole proprietor we mean that there is one owner who is responsible for all the obligations of the business, definitely for all the financial obligations of the business. But if there are multiple owners, you can register your business as partnership, and then these partners will be jointly responsible for the obligations of the business. But of course there can be there is a limitation on the number of partners, and in most countries partnerships can only have a maximum number of 20 partners. So if you want to bring in hundreds or even thousands of owners into a business, if you are setting up a huge business, you will actually need to do that. In that case, you can register your business as a company, and in company there can be any number of owners. Now of course there are other differences as well between these structures, and company is the most sophisticated structure in many ways, but we are not going to discuss that for now because that will deviate me from my original topic. So I will just focus the company as in a way of getting any number of owners in the business. Now how equity works in a company is an important concept, and we need to discuss that in detail. So in case of the company ownership is split over multiple fractions. You can make 100 fractions or 1 million fractions or even 10 million fractions. This is completely your choice. When you are registering your business, you can make as many fractions as you want. These fractions are referred to as shares, or in the USA we also call them common stock or simply stock. Now to buy a share, to buy a common stock from the company, to be able to to be able to own this share, you have to give money to the business. And how much money you will be giving to the business for each share? At the beginning you will have to pay the registered value for a share. So what is a registered value? When you are registering your business with the government department, you will be defining the fractions, I mean the number of shares, and you will also be defining a value for your share. Usually it is $10. Now to buy one share from the company, you will have to pay the company $10 if that is the registered value. By the way, the registered value is also called face value of the share, or it is also called par value of the share. Now you want multiple shares, you want to inject more money into the business, you will be buying more shares from the company initially at the registered value. I am saying initially because as the business moves on, there will be a different value that we will be just talking about in a minute. But before that, let us focus here. Now of course this is a little complex to move your head around, so I will be giving you a complete example here. Let us say Alex registered a company with the name of Banana Company, and he registered 1 million shares, I mean fractions of the business, at the face value of $5 per share. Now to get 1 share of the company, he will have to inject $5 in the business. This is how the company will raise its initial equity capital. So Alex invested $10,000 into the equity capital of the company, and of course, to inject $10,000 divided by $5 face value, Alex will be issued 2,000 shares of the business. Now here we have two important things to remember. First of all, the registered share capital. When I say capital, I need to talk about the money value of the shares, not the number of shares. Listen, the number of shares are 1 million, I agree, but we have to talk about the money value when we are using the word capital here. So I would say 1 million shares, that is 1 million shares into the $5 face value, that is $5 million. The total registered share capital is $5 million, but this is quite, it will be something that is in the books, that is written where we are registering the company, but other than that it will not be that useful. What is useful and what we need to focus is issued share capital, and the issued share capital here in this case you can see is 2,000 shares at total value of 10,000 at face value of $5. So I would say issued share capital is 2,000 into 5, that is $10,000. Now the company has $10,000 in its pocket and company has started its business. And as we move on, we can say that the total share capital is of course 10,000, but company then made $4,000 in the profits. As we were buying and selling goods, we were trading, whatever we were doing, the business made $4,000 profit over the initial capital. And now the total equity of the business, we already discussed that equity also becomes part of the share capital, the part of the equity, because the profits relate to the owners of the business. So now I would say my total equity value is $14,000, or I can say my total business value is $14,000. Now this $14,000 will be divided over 2,000 to calculate the value of 1 share. I repeat, total value of the business including the profits is 14,000, but there are 2,000 shares that represent the ownership, so $7 will be the value per share, but we would call that book value per share. Why book value? Let me explain you. Listen, now everybody is seeing that this business is making very good profits, and as a result of that, people would like to buy that profit, buy that shares. And when people want to buy that shares, when everybody wants to buy that share, that is demand and supply game, the price of the share will increase than $7. Or alternatively, we can also say there will be an impact of goodwill. Listen, this business is making profits, there is a goodwill now, so the share price would practically in the market will be a little higher than that, and that will be the market value. How much that will be, I cannot tell you that, because the market value has to be decided by the market forces, and market forces are the actual number of buyers in the market. So only market can decide the market value. We cannot theoretically calculate that, but we could definitely theoretically calculate the book value. And of course you can see that behind these 2,000 shares there is a value of $14,000 in the company, so 1 share is definitely valued at least $7. Now let us say the business wants to raise more capital. Now let me repeat what I'm saying. These 2,000 shares are owned by Alex, and Alex owns 100% of the company, because there are only 2,000 shares in issue and all of that are owned by Alex. Now I'm not saying that Alex want to sell his shares and get the money back. I'm not saying that. I'm saying the business entity, the banana company, wants to raise more capital to be able to do more business, and for that what they need to do is they need to issue even more shares. So now the company issued another 2,000 shares to a new shareholder, and this time at $8 per share. Now after this issue, Alex will have 2,000 shares and John will also have 2,000 shares. So out of a total of 4,000, each of them will own 2,000, which means that both will be 50% and 50% owner of the company. Now, of course, to buy those shares, John will have to pay the premium because he is coming late. He has to get the premium to buy the same ownership. Earlier, Alex purchased 2,000 shares at $5, but this time John has to pay the premium, and that is $8. By the way, how much is the premium that John is paying? That is $3 per share. So the original capital, share capital, will still be recorded at $5 per share, and the extra $3 that the company will be receiving will be called share premium. Now if we record that, we will say share capital, share premium, and cash. Share capital is going to be $2,000 into 5, $10,000. Share premium is going to be 2,000 into 3, that is $6,000, and the total cash that the company will be receiving will be $16,000. So I hope that this is giving you a very good insight about the share capital, and share premium, and how the shares define the ownership of the company. With that, we are now ready to talk about equity even further, and we are moving towards our third component of the financial statement, that is statement of changes in equity. Let us do that in the next lecture. It's time to start preparing the statement of changes in equity, but before we go there, let me recap the equity. So equity has a component share capital, and then it has a component share premium. We just discussed that a moment ago, so I will move forward. Then we have retained earnings. These are all the profits that the business has made and that has been retained into the business. Of course, that is a component of equity. Then we can also have reserves from retained earnings. So basically these are retained earnings just reclassified into another head for some specific purpose. So for example, we can make a reserve for a machinery replacement, but you can say broadly speaking, this is just another way to define, another way to represent retained earnings. Then we have revaluation reserve. So what is that? So for example, say you have a property that you purchased for $1 million, and now due to the market changes, that is now valued at $1.5 million. So this additional $0.5 million also relates to the owners of the business. Eventually the owners of the business are eventual beneficiary, so we also make it a part of equity in our workings. Now with that, we are ready to take a look at the statement of changes in equity, and for that, first of all, we will give separate titles to all the all the columns we have. So we will have a separate column for each head of equity, that is share capital, premium, and then reserves. Then we will use the rules to define the balance at the beginning. So we will write down the balance at the beginning of the period, and then we will show all the changes, which include if there are any new share issue, we will add that as well. Then we will cover the revaluation as well. Of course, that goes into this part here, revaluation reserve. Then we will add the profits that will go into the retained earnings. So profits for the period will also be added into the retained earnings. And then we will be talking about dividends. Of course, when dividends are paid, the retained earning component is reduced. And then we have transfer between reserves. If we just like to reclassify our retained earnings to the revaluation, if we do that, that will also be shown here in the statement of changes in equity. And then finally we will have balance at the end. So this is actually a very straightforward and easy statement. And of course, we should have the report title here, which is the company name, and then we should also have the period. We should also mention the period for which this report is going to be prepared. So this is a statement of changes in equity, and I hope that you have found that pretty straightforward. Welcome back. So now that we know the fundamentals of profit and loss statement, balance sheet, and the statement of changes in equity, what we are going to do now is we are going to prepare all these three statements from the accounting data that we get. So basically, after all the recording of expenses, income, and all other assets and liabilities, accountants and bookkeepers prepare a summary report which is called trial balance. And from this trial balance, all the other reports are prepared, and we are definitely interested in preparing the financial statements. So if we look at the trial balance, you can see that first of all, the trial balance is prepared for the year ended 31st of December 2019, which means that this cover all the income, expenses and asset and liability, everything for this particular year. This administration expenses, for example, covers the full year administration expenses for the full year of 2019. Now from this list of all the balances, let us start preparing our profit and loss statement. And of course, the first thing that you have to do is to decide which of these all expenses and everything here, which of these items have to go to profit and loss statement and which of them has to go to the balance sheet. And of course, we also have to decide the right order. And of course, we can say that you can simply copy this format from somewhere, or you can save this format with you for your future reference. Now let us begin from the P&L and let us begin from the sales. So we have to start our sales, and sales are recorded at $1 million. By the way, I forgot to mention one thing. This trial balance here has two columns. This DR shows the debit side and CR shows the credit side. It is definitely important for these balances are coming from accounting, and these definitely has a significance why each side is why each value is appearing on a side. But for this moment we can simply ignore that, and I would say just forget that fact that there are two columns here, and you can simply continue considering there is only one column and these are just a list of balances. Practically, yes, there has to be a little bit consideration that we have to give here, but we can ignore that for now. I have kept the data very simple for now. So after the sales, we have to record our cost of sales, and it is a good practice to present the cost of sales, it is an expense, as a negative value. And since my cost of sale, if I show you here, is shown as a positive value here, what I'll do is I will manually add a minus sign, and this will make my value negative. And now gross profit, gross profit has to be sales minus cost of sales, but since my cost of sales is already a negative value, I can simply sum these two values to find my gross profit, which is correctly calculated at $700,000. Now of course you are thinking that you may be thinking that rather than manually bringing in every value one by one, you can use some smart Excel technique like VLOOKUP or XLOOKUP to fetch that value very quickly. And of course, if you do that, you can prepare your financials within seconds. But here I just want to focus on values, and I want to explain as we move forward, so I will be doing that manually. But if you use VLOOKUP, that is even better. Right, so my next head is marketing expense, so I'll go that here and I'll find marketing expenses. And again, since I have to show the value as negative value, I will manually add a minus sign here. Let us move forward to the administration expenses, and then let us move forward to the sales and distribution expenses, and then we can calculate our EBITDA. And how we can do that? We just have to pick up our gross profit value, and then we have to deduct all of these three values. So I would say sum of all of these three cells, and that should give me my EBITDA value. Now of course I made a mistake, and that mistake was it was already these expenses are already in negative, so I don't need to use the minus sign. So I will simply do the sum of all of these values together, and it will calculate EBITDA for me correctly. Then we have depreciation and amortization. We did not discuss in detail that what are these expenses, but I just told you that these are some special kind of expenses that we need to discuss later on. So we'll move the similar way for now. I would say these are expenses and move forward from here, so that we can complete our financials. And definitely in the upcoming lectures you are going to get a brief overview of what is depreciation and what is amortization. For now, let us just treat them as expenses. And then again, I just need to sum up all of these values. And here we have our operating profit. Then we have dividend income and interest income. So let us find that from our from our trial balance. So dividend income, and then we have interest income, that is here $6,000. And then let us sum all of these values together, and here we have our PBIT. Then we have to deal with interest expense, that is here $10,000, and then also calculate profit before tax. And by the way, sorry, interest expense should be negative as well, so I would say minus 10,000. And then let us sum these values to reach the profit before tax, and then also add the tax, that is 79,590. And now we can calculate our profit before tax, that is 299,410. So I hope that you have found preparing profit and loss statement very straightforward. Now let us talk about the balance sheet. Now balance sheet begins from the asset side, and let us talk about the current assets that we have to find. So first of all, we have inventory. I'll go there and pick up the value, that is $40,000. Then we have trade receivables, that is here at the bottom, this is $30,000. So trade receivables are basically the money that you will be receiving from your customers in the future. You already have provided them goods or services, but you will be receiving the money from them in the future. So that is definitely our current asset. Then we also have to pick the cash and cash equivalents. Here we have the cash and cash equivalent. Then we have interest receivable, that is the interest income that we have earned but not yet received. So here it is, $2,000. And then we have dividend receivable, again the dividend that we have earned but not yet received. Then let us talk about the investments. So investments are basically, it is kind of you must have purchased the shares of some other company or the bonds of some other company. These are also your assets because you can sell that to make money. And let us sum all of these to calculate total current assets. Now on the non-current asset side, first of all we have property, plant, equipment, that is here $400,000. Then we have intangibles, that are trade licenses, so that should be somewhere here $80,000. And now let us also sum them up to calculate our total of the non-current assets. And finally, let us add together a total of current assets and non-current assets to reach at total assets. After the asset side, we have to work on the liabilities, and let us begin from the trade payables. So trade payables are given here, and these are $25,000. Then we also have other payables, and you can see that other payables are $15,000. Then we also have interest payable, which is if I just find that out, $4,000. And then we have tax payable, that is here $79,590. And then we can calculate the sum of total of current liabilities, right? After that we have to find the bank loan, and you can see that my bank loan amount here is $200,000. I'll pick that up. And then if I scroll down, you can see I have even other parts of the balance sheet. So first of all, let me calculate the total of non-current liabilities. That is nothing but just a formality. We should put in the formulas for the future. So if we add any value here, that will automatically be added here as well. After that, let us move to the owner's capital, where we have share capital first of all, and that is given here. Then we have share premium, that is $50,000. Then we have retained profits. Now if you look at your trial balance, you do not have any retained earnings account here, which means that there was no opening retained earning coming from the previous period. And yes, this is basically my first year of business, so there is nothing coming from the previous period. So I will say that there is nothing. Opening retained earning is 0. But yes, then we also made the profits this year, that is shown here, that is calculated here in my profit and loss statement. And this profit will become the part of retained earnings, so I'll add that here. By the way, if there was a value in my trial balance, I'll pick that value, and I'll also add this yearly profit to reach at my retained profits for that particular year end. And then now we can calculate the total capital, which is this value here. And finally, let us add together the total of, okay, before I add together the total of liabilities and capital, I forgot to calculate the total of liabilities. That should basically be the total of current liabilities and the total of non-current liabilities. So if I just do that, you can see I have total liabilities now, and now I can calculate the total of liabilities plus total of equity capital to reach at my total of liabilities and capital. And hence we have prepared our balance sheet. And just a quick check, our total of assets should always be equal to total of liabilities and capital, and you can see here we have that check correctly. It is we can say it is right. So we have prepared our balance sheet, and finally we can also move to the third component of financial statements, that is statement of changes in equity. So we have to begin with share capital, premium and retained earnings. I haven't added more lines here simply because there were no other transactions. So for example, there was no revaluation reserve, so I haven't added the line for that. But if there if there is other line item, for example there are reserves, you have to add a new column for that as well. For me it is nothing. So balance at the beginning for all of these three is going to be 0, so I'll simply say 0 for all of them. And then issue of shares. Now in the period you must have issued new shares, so that you have eventually at the end of the period you have share capital and share premium here in your balance sheet. So I will say in the issue of shares you have received a share capital of $100,000. Again, if the balance at the beginning was 0 and your balance sheet says there is a share capital of 100, that must be coming in this particular period. Similarly, share premium is $50,000, so I can pick up this value from the balance sheet. And then the next line is for profit for the period, which is already shown here in the retained earnings, or you can also pick that up from the profit and loss statement. And we have done that, and all we need to do now is to calculate the ending value by adding all of these together. Again, there is nothing to add, I'm just adding the formula so that if there are values in the future, my balances will be updated automatically. And with that, we have prepared our statement of changes in equity as well. Yes, there is a component, that is cash flow statement, that we haven't prepared yet because we haven't simply learned that yet. Once we do that, we will come back and prepare that as well. And finally, we have notes to the financial statements. These are for the accountants, so we don't need to focus on that. We can simply ignore that for now. Okay, so with this, we are now ready to move to the next components of the financial statements. Now that we have a good understanding of how to prepare the financial statements, specifically profit and loss statement, balance sheet, and the statement of changes in equity, let us practice that and let us prepare for the second year of business, that is financial year December 2020. Now you have the trial balance and you are supposed to prepare all these financial statements. But one thing that is different from the previous exercise, from the previous year to this one, is this is the second year of business. So there are some opening values as well. But here when you are seeing this, you are seeing this trial balance at 31st of December, which means that all of these values are closing values at 31st December, except these retained profits. So retained profits are basically what are appearing here in the trial balance are the opening value for this year, and this is because the profit for the period of 31st December is yet to be calculated in the P&L. And once we calculate that, we will merge that with this retained profit and that will go to the balance sheet. So I repeat, all of these values are ready to go to the P&L and balance sheet. But this value of retained profit will also be compiling the net profit from this year, and then that will go to the balance sheet. Now with that being said, if you are confident with the previous lecture, you may like to pause this video now and solve this yourself and then come back to check the answers. Now we are going to solve that. So let us begin from the top, and sales value is coming from the trial balance, and here it is, this 1.6 million. Then we have cost of sales, and you can see my cost of sales is appearing here in my trial balance, but this is just a number without telling me about positive or negative. In my P&L, I have to show my expenses with a negative sign, so I will add the minus sign myself, and then I will link the cell, and now you can see my cost of sales is appearing with a negative sign, and then I will sum up these two values to calculate the gross profit. Similarly, for all of these expenses, we can link our trial balance, but one thing that we will be doing is to make sure that our expenses are coming in negative sign. So marketing equals minus, and here we can see marketing expenses 180, then administration expenses of 72,000, and then sales and distribution expenses are 100,000. Now to calculate the EBITDA, I will say sum of all of these values up to gross profit. Since gross profit itself has compiled all the values above it, we don't need to go further to that. So I will close the bracket and press enter. Here is my EBITDA. Now let us talk about depreciation. Again, we will make it a negative value. So depreciation is here. And again, let us do the same for amortization expense as well. And now we can calculate our gross operating profit with all of these values. And now let us talk about non-operating income and expenses. In our case, both of these are income, so we will present them as positive value. So I'll say dividend income here is 12,000 and interest income here is 15,000. And then we can calculate the PBIT again by using the sum formula for all of these values. And here we have our PBIT. Now let us talk about expense, interest expense. Make it negative first of all, and then let us find interest expense. Here it is. And then we have, profit before tax. So I'll again sum all of these values. And now let us talk about tax. Again, let us make it negative value. And tax is here, that is 130,200. And now we can see our net profit as well, and that will be sum of these two values. Right, so we have calculated our net profit, that is 489,800. So I hope that you have found this very straightforward. Now we are ready to start preparing our balance sheet as well. So let us start doing that. Now, by the way, before I jump to that, I would like to tell you one thing, and that is, in reality, the lines of trial balance can be much more than this. These lines can be literally in thousands. So what we do is we use, rather than typing in everything one by one, we use the VLOOKUP formula to pick up the values automatically. So rather than bringing in every value one by one, we can use the VLOOKUP formula. Now let us talk about our inventory value. Now inventory value can be seen in the balance sheet, and that is here $75,000. And then we have trade receivables, which can be seen here. This is trade receivable, 85,000. And then we have cash and cash equivalents, that is 877,210. Then we have interest receivable, which is this value here. Then we have dividend receivable, which can be seen somewhere here, this value, yes. And then investments are, if we can find it out, investments are 80,000. And now we can sum up all of these total current assets. So if we sum all of these, that will be our total current assets. Now let us talk about non-current assets, and let us begin with property, plant, equipment. So we have this value straightforward, and then we have trade licenses, and if we can find that, here we go. And now let us sum these two to calculate our total of non-current assets as well. And finally, let us add together the current and non-current totals to reach at the total assets. Let us quickly solve our liabilities section as well. And here we can see our trade payables, which are, if we can find that, here we go, 55,000. and then other payables are 30,000, and then interest payable is $10,000, and then tax payable is $125,000. And now we can add all of these values together to reach at our value of $220,000. Then we have bank loan, which is this value 300,000, and then we are supposed to find the total of non-current liabilities as well. So I will just do this step. And finally, let us move towards our owner's capital, where we have to find the share capital. So share capital is here 150,000, and then share premium is 110, and then retained profits. Now let us see this. So from the trial balance, I'll pick up this value, but I will also add the net profit from my profit and loss statement, and that will give me my total capital. So I'll add these three, and that gives me my total capital. And now what I will do is I will find the total liabilities and capital, which is total capital plus the total of the liabilities. So that should be this cell here. We do not have value, so I'll go back. I will say total liabilities were total current plus total non-current. So I'll do this. I'm sorry. So I'll do that again, equals current plus non-current, and that is 520. And I'll go back and I will say 520 plus total of the capital, and that is 1569210. Now one quick check that we need to perform is our total of liabilities and capital should be equal to our total of the assets. So these two sides are equal. That means that there is a reasonable check to say that our balance sheet is correct. Now after that, let us also go to our statement of changes in equity. Now the statement of changes in equity, if we scroll to the right, we can see the format, and this statement is supposed to show the opening balances as well. So we have mentioned the opening balances from 2019 here, and now we have to add the changes that has happened in the year in the equity. Now issue of shares, definitely we can check our schedules and pick up the share capital and premium from there, or we can work out from the balance sheet as well. So here we can see that we already had share capital of $100,000 in our equity, but if I go to my balance sheet, you can see that at the end of the year you have $150,000 in share capital, which means that additional $50,000 have been raised in the equity. So I'll add $50,000 here in the share capital, and the same thing has to be done with share premium. At the beginning you had $50,000 in the premium account, but if we scroll down, you can see that now share premium is at 110, which means that an additional of $60,000 have been added into the share premium account. So I'll add 60,000 here, and then for the profit for the period, we have to link our profit and loss statement. So I'll say this value and then link that to our profit and loss statement value, which is here. I can see that here, so I'll link that, the net profit value, and you can see we have our profit now. So let us calculate balance at the end, which is sum of all of these values above, and then we can just link that, and this is the closing equity. So by the way, this equity should be equal to the equity value in our balance sheet. So just to check that, I'm adding these values, that is equivalent to 1049210, and then in my balance sheet the owner's equity is 1049210. So we are done with this equity statement as well. So I hope that you have found this thing very easy, and once you are confident, you have an assignment right ahead. It's now time for your assignment, and all you got to do is to prepare the profit and loss statement and the balance sheet using this trial balance given here, and this is for the year December 2021. So other than that, You may also like to prepare your statement of changes in equity. However, the profit and loss statement and the balance sheet are our main focus. Once you are done, you will have the option to check your answers, and also you will have a tutorial video where I will solve this assignment for you, and if there are any questions or mistakes, you can see that there. So now let us talk about this important concept that we have been delaying for some time, and this is called depreciation. So rather than me telling you a theoretical definition, let me give you an example, and let us say we purchased a machinery at the beginning of 2023 for $5 million, and we expect to use that machine for the next 5 years from 2023 to 2027. Now we have incurred all of our cash outflow. The complete expense has been incurred in this year 2023, but the benefits will be accrued over the next 5 years. So the accounting standards require us to split this cost of $5 million over the next 5 years, and there are multiple ways, there are multiple accounting methods of doing that, but the simplest one that we can use is a straight line in which we equally split the cost over the complete life. So I would split the cost of 5 million over 5 years, and this would be $1 million. So rather than charging the $5 million cost in year 2023, we will rather split that and allocate that to the whole life of the asset. Now this $1 million that we are charging here for this asset, for this machinery, to each year from 2023 to 2027, this $1 million will be called depreciation. So one more thing that I would like to say here, when you purchase the machine, you have to pay the cash, right? So the cash outflow must be occurring in 2023, but the expenses will be recorded gradually over the 5-year period. Now let us cover some key points. First of all, depreciation is allocation of cost of an asset over its useful life. We just got to know that. And secondly, there are two key points which we should keep in mind. First, depreciation is an expense. Of course it is, because our machine's value is falling down and we are recording that. And then the other thing is depreciation is a non-cash expense. So usually in other expenses, when you incur the expense, you also, with the delay, there may be a delay of some days, but you also pay that within the same period. But in depreciation, the cash outflow is not occurring at any time now or in the future. It must have occurred somewhere in the past. So we say that the depreciation is a non-cash expense. I hope you have found this concept very easy. To be able to do financial reporting or financial modeling, we do not really need to know accounting in detail, but a basic understanding of what is accounting will be helpful for us in the overall process. So first of all, accounting is recording and reporting of financial transactions. What does that mean? Let me explain you. First of all, when we say financial transactions, we mean that the transactions in which we are giving the financial value or receiving the financial value. So for example, sales return, inventory purchase, expenses, loans, asset purchases, and many others like loan repayment or receiving the money from shareholders. All of these are transactions in which we are receiving the value or giving the value. So we call that financial transactions. Now accounting is the recording of all of these transactions as they are happening. We are recording that, and then once we have recorded all of these transactions and we have prepared the records, we have to prepare the reports out of that. Now even though we are only looking at the very specific reports, financial statements, there are many other reports in the business. So for example, regarding to sales, I may be needing a report that is showing me the annual sales, or I may need a report showing sales for a specific month, or showing sales from a specific customer, or showing sales from a specific product category, or showing sales of a specific product item, a specific inventory item, right? So there can be many different reports. Similarly, for expenses and all other things, we can have many different reports. The financial statements are a part of these reports, which basically summarize everything together. Now this is the basic reporting, and you should be thinking that this is very simple, right? But we have to do the accounting in a systematic way as required by standards. Now there are two things to it. The first thing is, when we record something in our normal life, we do a plus, a minus, right? When we have to increase something, we do the plus, and we have to decrease, we do the minus. In accounting, we don't do plus and minus, rather we use an alternative system, that is debit and credit. Well, we don't really need to know that leave that for accountants, but we have to know the other aspect of this statement, that is in a systematic way as required by the standards. And what does that mean? Let me explain that to you with the help of an example. Let us say our business has purchased a truck at the beginning of 2023 for $10 million. And we are supposed to use this truck for the next 5 years. Now accounting standards require us that we do not record the expense of $10 million here in 2023. Rather, we split the cost of $10 million over the life in which we are going to get the benefit. So we would be splitting this cost over the 5-year period, and we can say 2 million each year. That will make up to 10 million. Now there can be other ways as well, where there can be a different amount, but broadly speaking, this is the right way of going about it, that we are dividing the cost over the life of the asset. So by doing this, accounting is ensuring that we are showing the cost and benefits of the truck in same period. Had you charged all of this $10 million in 2023, this year would have been bearing all the expenses, and these years would have been bearing all the benefits, and the readers of the report may not be getting a fair view of the business. Now, why is that important? This is because in business there are many external stakeholders that are connected and who are reading your reports to take important business decisions. So there can be investors, there can be banks who have to lend you the money. So they are looking at these reports which have been prepared by you in your accounting, and they are going to take important decisions about your business. If your reports are not following rules and regulations, if you don't have to follow the rules and regulations, you may prepare the reports in a way that mislead the users of the report. Now, of course, even if we talk about small business where there are no investor or no lender, still there are external stakeholders. For example, the tax authority. The tax authority has to charge you the tax on the basis of the profits. And if you are allowed to do the accounting in any way you like, you may like to do the accounting in a way that that there are no profits in the period, so you don't have to pay taxes. So in accounting, we have to follow the rules and regulations so that everyone who is looking at the accounting report is going to get a fair view of the business. Now, this much introduction of accounting is sufficient for us to be able to do our reporting and financial modeling, but I will be talking about few specific things from accounting that will be required for us. For example, depreciation and amortization, and we are going to do that in the coming lectures. So we have just learned about depreciation. Amortization is just another term for depreciation, specifically used when we are talking about intangible assets. So the term depreciation will be used for tangible, I mean the assets which have physical substance like property, plant, equipment, motor vehicles. But when we are talking about intangible assets like goodwill or patents or trademarks, we will be using the term amortization. So amortization is an allocation of cost of an intangible asset over its useful life. Welcome back. So we are now moving towards our last financial statement, that is cash flow statement. But before we start talking about cash flow statement, we have to first understand some fundamentals. And the first thing we need to know is When we are talking about cash in accounting and finance, we are talking about cash and cash equivalents. Cash equivalents are basically your current assets which are quickly convertible to a specific value. So for example, if you have gold coins, there is a ready market where you can go and sell them instantly. So we call them cash equivalents. Similarly, if you have government bonds, they are also classified as cash equivalents. The second thing that we need to know is we need to answer ourselves a question, and that is, why is cash so important? And a very simple answer to that is, just like in our life, no matter how expensive house and cars and everything we have, if we don't have cash, we cannot even buy groceries for us. It is that simple. Similarly, in the business organizations, no matter how huge plant and machinery and inventories are there, if you don't have cash, you can simply not pay your daily expenses, and so you cannot run the business. So cash is the fundamental thing to run the business, and this is compared to the blood in the human body. So it has to be there to be able to run everything. And then the next thing that we need to know is profit is not cash. Now we have seen our profit and loss statement and we calculated profit there. But the thing is, if we tell you that a company made a profit of $5 million, it does not mean company generated cash of $5 million or company has cash of $5 million. None of these statements apply. So the profit is something very different from cash. And why is that so? Well, the first reason is accounting is done on accrual basis. Now, what does that mean and what is accrual basis? Well, accruals concept mean that in accounting, expenses are recorded when they are incurred and not when they are paid. So what does that mean? Let us say we pay for our utilities in the next month, and we have consumed the utilities in the full month, but the bill is yet to arrive in the coming month and we will pay off some days after that. But we still have to record our expenses in this month. So expenses will be recorded when they will be incurred regardless of when you actually pay them. On the other hand, very similarly, income is recorded when it is earned and not yet when it is received. Let us say you have purchased some services from me. I have provided you the services, but as per the terms of the contract, you will pay me after 6 months. But since I have already provided you the services, I will be recording my income now and not when you actually pay me. So I will record my income now and I will record a receivable in my books that I need to receive the money from you. But when we eventually receive the payment, that will not be the point when we record our income. So this is the first reason why cash is different from profit. The second reason is cash flows from the purchase and sale of fixed assets are not a part of P&L. What that means is, if we are purchasing the machinery, we definitely have to pay the cash for that, but this whole transaction will not go to profit and loss statement because machinery is not an expense. This is purchase of asset, so this transaction is not going to profit and loss statement. So my cash has reduced, but my profit will remain unaffected. Similarly, if we are raising any debt or equity, definitely we will be receiving the cash, but there will be no impact on profit. So the conclusion is profit is something different from cash, and that's why we need a separate cash flow statement. So I would conclude, the first thing we discussed was we have to prepare the cash flow statement because cash is very important. It is like the blood for the business. We cannot survive without it, and every investor, every reader of the reports should know how well the company is doing with its cash. And secondly, we need cash flow statement because the profitability statement, I mean the profit and loss statement, is not sufficient to tell us about the cash. With that, we are now ready to talk about cash flow statement, and let us do that in the next lecture. So now let us talk about the cash flow statement in detail, and for the purposes of cash flow we will separate the operating activities, investing activities and financing activities. With operating activities we will say that we are talking about the day-to-day business activities. With investing activities we will talk about the investments that business make, even in the property, plant, equipment, or even in the third party external instruments. And in the financing activities we will talk about the cash flows that are coming from the financing of the company, I mean if we are raising debt or equity. So let us begin by operating. So in the operating activities we will consider all the cash received from customers and cash paid to the suppliers, of course for expenses, and then we will also include the interest paid and tax paid in this part of the cash flow statement. In the investing section we will include all the cash that is being paid to acquire a fixed asset, or cash that is being received if we sell those fixed assets. Similarly, if we make a third party investment, if we invest somewhere in form of the other company's shares or their bonds, or even if we make a bank deposit, that cash flow will be considered here in the investing activities. And finally, of course, the cash dividend and cash interest that we receive over those investments are going to be covered here in the investing section. Finally, if we talk about the financing activities, this is where we would include all the cash that we receive on the issue of shares or issue of bonds, or even if we receive cash in form of bank loan, that is also going to be considered here. Finally, if the company distributes the dividend on to its shareholders, that is going to be covered here in this financing section. So I would conclude the cash flow statement will be split into three sections: cash flows from operating, investing and financing. Now how will this cash flow statement actually look like? Let us take a look. So again, let us begin with the same format. On the top we have company name, then the report title, and then the period for which it is being prepared. And this report will begin by mentioning cash and cash equivalents at the beginning of the year, and then we will show all the changes from operating activities, and then all the changes from investing activities, and then all the changes from financing activities, all the inflows and outflows, of course line by line. And then we will net these three values, I mean operating, investing and financing, to calculate the net cash that has been generated in the year. And finally, we will use the opening cash, we will use this net cash generated in the year to reach at the cash flows at the end of the year. So I hope that you have found the cash flow format very simple, but in the next lecture we are going to talk about the operating, investing and financing calculations in a bit more detail. So looking at this screen for the cash flows, you must have thought that preparing the cash flow statement must be very easy. But there is a small problem, and that problem is, if you notice, I have already given you cash received, cash paid, cash received, cash paid here. But in reality, these values will not be very easy to find. There are two reasons for that. Number one, all the accounting records are maintained on accrual basis, which means that the values will not be ready for the cash. And secondly, going to the ledgers and finding all of these values is going to be a little complex. So what we rather do is we only look at the profit and loss statement and the balance sheet, and we extract the values, the cash values from there. Now it might look a little complex at the beginning, that how we are going to extract the cash values from profit and loss statement and the balance sheet, but in reality it won't really be that difficult. So to understand that, let us take one example, and let us begin from one example of loan, and everything will be worked out in the same way. We will be taking more examples, but let us begin with the loan. So we are working out cash received from loan from the balance sheet in this example, and in this example we are gonna say Kangaroo Company, a company, started the business in 2019, so there should not be any opening value for 2019. I mean, the values should be 0. And we are being given the balance sheet for the last 3 financial years, and we are supposed to calculate the cash received from loan. Now, first question here must be why we are only being given the balance sheet and not the profit and loss statement. The answer is very simple. The loan only goes to the balance sheet. So if we are receiving the loan or if we are repaying the loan, there's nothing that goes to the profit and loss statement. So profit and loss statement is irrelevant at this moment. So let us look at the balance sheet. So we have the 3 years, and for each 3 years we have the value. Now please keep in mind, this is balance sheet, which means that the loan of $50,000 here and $80,000 here and $100,000 here is the closing value. It does not mean that we received this much loan. It only means that at the end of this year we have so much loan that is, that we have taken until now at this particular moment. So at the beginning of 2019 there was no loan at all. Of course, we just started the business, but as we move forward you can see that 2019, ending of 2019, the loan value is $50,000, which means that we must have received the new loan of $50,000, and which means that we must have received the cash of $50,000. So I would say cash received in loan is $50,000. Now from 2019 to 2020, as we move forward there, you will notice that from here to here your value has increased, your loan value has increased by $30,000. It means that we only must have received an additional loan of $30,000. And now finally the same concept applies here. From 2020 to 2021, the loan value has increased by $100,000. So we would say that the loan has only increased by $20,000. So my cash received is $20,000 here. So this way we can find out the cash received or cash paid from loan by looking at the balance sheet. And this applies to almost all the different things that appear there in P&L and balance sheet. So we are going to take some more examples like this before we move on to prepare a complete cash flow statement. So we have to now work out cash received from shareholders from the balance sheet. Again, the cash received from shareholders does not go to profit and loss statement, so we don't have to look at the profit and loss statement at all. We just need to focus on the balance sheet. And for that, let us consider an example. And let us say Kangaroo Company started the business in 2019, and here's the balance sheet for the last 3 financial years. By the way, we have just started the business in 2019, so the beginning value for 2019 would be 0. So here is the balance sheet, and in that balance sheet for all 3 years we have share capital and share premium. Now we have to recall that point that share capital and share premium both represent the money received from the shareholders. So we will consider both of them together. So looking at 2019, at the beginning of this year there was no balance in share capital and share premium. So from 0 you have reached 100,000 in share capital and 400,000 in share premium, which means that you have received a total of 500,000, 5 lakhs in 2019. So I would say cash received from the issue of shares must be 5 lakhs. Then in 2020 you can see that from here at this value, if I can just represent you, from this value of total of 500,000 you have moved to a total of 650,000. So there must be an additional of 150,000 that you must have received from the shareholders. Now please pause this video and calculate the cash flow for 2021 yourself, and you can see if you sum these two, that should be equal to 830, and the difference of from 650 to 830 you have moved towards a total of 180,000 additional has been received from the shareholders. Now again, please pause this video and check the value for this 2020. At the end of year 2022, you can see that the balances I have shown you here. For share capital, the balance is 180, and for share premium, the balance is 650. And you have to tell me how much cash you have received in year 2020. Now pause this video and come back when you are done, and the answer is 0. You haven't received any money from shareholders in year 2022. So this is year 2022. Okay, so I hope that you are getting hands on with this concept, and with this example now we are moving towards a little bit more complex ones where we have to look at the profit and loss as well as the balance sheet. Let us do that from the next lecture. Let us now calculate the interest payment from the profit and loss statement and the balance sheet. So let me explain you first. In the profit and loss statement, interest expenses would have been recorded. The payments are not recorded there, and payments are different from the expenses. And similarly, in the balance sheet, only interest payable would be recorded, which means that if you have incurred the expense that is in the P&L, and that expense, if it has not been paid yet, it must be in the balance sheet. So we have to look at two of them together to be able to find the interest payment. So let us begin from there, and let us say Kangaroo Company started the business in 2019. Again, I want to ensure that we know the opening point, and the opening point is 0. And here is the profit and loss statement, and here is the balance sheet of the company. So these are the values that are available in P&L and balance sheet. Now if you look at the year 2019, you can see that in the first year we incurred an expense of $20,000, and then you can also see that all of this expense is still being shown here as your payable. So this 20,000 is still payable on your balance sheet, which simply means that you haven't paid anything at all in form of interest. Now this was first year, so it was a little more easy to understand, but in the next year it will become a little complex. So we would rather learn a systematic way of doing that, and that systematic way is, let us create this small schedule where we mention that the opening balance is 0, and then the interest expense will be added here, and then we will calculate the closing balance, that is also $20,000. It means that there was no payment at all, and if there was any payment here, that should have been deducted here, right? So I hope you are getting my point. So opening balance plus interest expense, and if we had made any payment, that must be deducted from here. So this is what I am going to do next. I would say the interest payment in this case must be 0, and that is exactly why the closing balance is again $20,000. So if you are not clear, don't worry, we still have 2 more times to do that. Right, so let us talk about the interest payable of 2020. And now for the 2020, the opening balance must be $20,000. You can understand that the closing of 2019 is the opening of 2020. So the opening balance is $20,000, and then there is an interest expense that we can see from the P&L, and that is $28,000. Now it means that if we haven't paid, assuming that we didn't pay anything in 2020 as well, it should mean that my closing balance should be 20 plus 28, that should be somewhere around 48,000. But my balance sheet says that my closing balance is 20,000. It means that we must have paid something which has been deducted from here. And how much was that? I'm sorry, how much was that? That interest payment has been 23,000. Only then the closing balance of 25,000 can be calculated. So I hope you are getting my point here. So again, I repeat, opening balance plus interest expense minus interest payment equals closing balance. Please treat it like an equation. And let us do that one more time for 2021. And I hope that you are clear with the calculation. And if that is the case, please pause this video and do 2021 yourself and then come back. So let us continue. So the opening balance for 2021 is definitely going to be 25,000. That is coming from the previous year. The interest expense for this period is $40,000, so we will add that. And this should mean my closing balance would become 65. If I didn't pay anything, my closing balance would become 65. But when I look at the balance sheet, I see that there is a payable of 36,000 only. So there is a payment, and the payment is the difference between my 65 calculation and this 36, that is $29,000. So I hope you have found this concept easy, but don't worry, we have one more time to do that. We are going to do that again, the same thing again, but this time for the tax payments. Let us do that in the next lecture. Let us work out the tax payment from profit and loss statement and the balance sheet. And again, just like interest, tax payment cannot be seen either in P&L or the balance sheet. Tax expenses on the accrual basis can be seen in the profit and loss statement, and then if those tax expenses have not been paid, they must be sitting in the balance sheet as taxes payable. So let us again consider the same scenario. We have Kangaroo company and we have the profit and loss statement for that company for the last 3 financial years, and also we have the balance sheet for the company for the last 3 financial years. Now we have to work out the tax payment from this tax expense in the P&L and tax payable in the balance sheet. And by the way, if you are confident with the interest calculation in the previous video, you can pause this video right now and you can do the workings yourself and then come back to check the answers. But if you are not, let us continue. So let us say for the year 2019, the opening balances. We know that we just started the business in 2019, so the opening balance has to be 0. And then expenses for the period were $8,000, right? So we would say that tax expense is 8,000, and then the closing balance is 2,000, which means that out of the 8,000 expense, you must have paid your $6,000. That is why the closing balance is only 2,000. For 2020, we will begin with the opening balance of 2,000, that is coming from the previous period, but then we have to add the new tax expense that is in the P&L, that is $12,000. And now this opening balance plus tax expense means the payable now is $14,000, and if that is not in the closing balance, that must be paid already. And as we check the closing balance from our balance sheet, the closing balance is 3,000, which means that we must have paid $11,000. Let us talk about 2021. The opening balance is 3,000, and then the tax expense coming from P&L is 16,000, and then the closing balance that is appearing in the balance sheet is 5,000. Now if opening balance was 3,000 and tax expense was 16,000, the liability became 19,000, but only 5,000 is pending, which means that we must have made a payment of $14,000. So this way we have found the payment, the cash outflow that must have happened in form of tax payment. I hope you are confident with it now. Let us talk about calculating cash paid on the purchase of non-current assets or cash received on the sale of non-current assets. And again, we will be finding that information just by looking at profit and loss statement and the balance sheet. Now, balance sheet is obvious that if you are purchasing the asset, that is going to the balance sheet. Similarly, if you are selling the asset, that is getting off from the balance sheet. But why P&L? This is because of depreciation. So when fixed assets are depreciated, that depreciation goes to profit and loss statement. And because of that depreciation, the value of the fixed assets fall in our balance sheet. So these two are connected. So we have to look at both of them to get this working. So let us begin first of all by looking at the scenario. So again, Kangaroo company just started the business. It is 2019. Here in the profit and loss statement, the balance sheet for the last 3 financial years are being given. And then there is some further information that you can simply read. Now here, first of all, we have the profit and loss statement, and you can see we have depreciation of $40,000 for each year. And then we have the balance sheet, in which you can see that you have this plant and machinery, which in 2019 it was 160, then it became 120, and then it became 0. So let us start our workings from 2019, and the target is to find out what was the value of fixed assets that was purchased in 2019. So before I go to the working, we can, let us discuss and manually try to find it out. So you can see that at the end of 2019, the value of, definitely this is 2019 end, and at the end the value of the fixed asset is $160,000. And the fixed asset was also depreciated by $40,000 in the period, which means that the original value of the asset was so high that after the depreciation of $40,000, now we are at the value of 160. So the original value of the asset that must have been purchased in this year must be $200,000. Okay, now let us do the workings, and opening balance is 0, definitely this is our first year, and then the depreciation, whatever the opening balance was, the depreciation must be deducted, that is $40,000, and then the closing balance became 160. So of course in this calculation, if there are any additions to fixed asset, that must be added, and if there are any removals, that must be a minus sign. So now if we just solve this calculation as a mathematical equation, that is opening balance minus depreciation plus additions minus deletions equal closing balance, if we solve that equation, you can find that out that the purchase of the asset must be $200,000. Okay, let us move to the next year, and in that year the opening balance will be coming from the last year, that is $160,000, and then you depreciated the machinery by $40,000, so we expect the closing balance to be 120, and it is 120. That's nice. It means that there's nothing else, there is no new addition and there is no deletion as well. So it's simply, there is nothing to find out, there is no cash inflow or outflow. So I would simply conclude that in this year there is no cash flow from plant and machinery. And then let us talk about 2021. In this year the opening balance is 120, and then the depreciation is 40. So you would expect the closing balance to be $80,000, but here it is 0. So where is the $80,000? That must have been removed. It means that the asset has been sold. So the sale value must be $80,000, and since this is, we have to remove this, we are calling that a negative value. So now you can see how we can find out the purchase and sale. And the final point, on the purchase this $200,000 must be cash outflow, and on the sale this $80,000 must be cash inflow. So when we go to our cash flow statement, this purchase will be treated as cash outflow and this will be treated as cash inflow. So please do not confuse this with the negative or positive sign. We can simply understand the cash inflow and cash outflow. So we are back to the same scenario again, but this time I want to tell you something different. So everything is same, the same depreciation and same plant and machinery values in the balance sheet. But we need to focus on 2021 this time, and I just need to add one information here on my profit and loss statement, and that is gain or loss on disposal. So in the previous scenario that we were just discussing in the previous lecture, there was no gain or loss on disposal, so our workings were completely fine. But now in this scenario, our profit and loss statement is telling us that in year 2021 there is also a gain on disposal. Since the value is in positive, it is showing me it is a gain. If it was a negative value on my P&L, it must be the loss, but right now it is gain. So we just need to focus on 2021 workings again, and as we begin, you can see we start with the opening balance for our fixed assets, that is 120 coming from the previous year. Then we deduct our depreciation, that is $40,000, and we expect the closing balance to be 80,000, but since it is 0, we conclude that the $80,000 worth of the machinery from my balance sheet has been removed, sold. But When you actually sold that machinery that was valued at $80,000 in your balance sheet, that resulted in a gain of $8,000. It means that over the book value, the $80,000 book value that has been removed, you have received $8,000 even over and above that. So the cash that we will actually be receiving would be $88,000. So I would say that the sale is $80,000, but the cash that we are receiving here in the sale of plant and machinery is $88,000. So we have to keep this thing in mind, that the balance sheet values of plant and machinery are book values. In reality, when we sell them, there may be a gain or loss, and that gain or loss will eventually be going to profit and loss statement, and in that case the cash flow will be higher. Now we are done with the cash flow part, but I just need to tell you one more thing, and that is, if we go back to our profit and loss statement study, we must recall that this gain or loss on disposal goes to the non-operational income or expenses, earnings or expenses. So that is just a reminder, the profit and loss statement reminder. So I hope that you have found this concept very easy, and now step by step we are gradually closing towards our preparation of full cash flow statement. So we know that in our profit and loss statement, the sales is recorded on accrual basis. The sales does not mean we also have received so much cash from our customers, because this cash might be coming in the future, because sales may have been made on the credit basis. So cash received from customers is something different from the sales itself. So in this example, we are going to work out cash received from sales from the profit and loss statement, but this time again we will be looking at the profit and loss statement and the balance sheet. And the reason is, if you have made the sales and you haven't received the money from customers, that must be in the balance sheet under the trade receivable section. So we have to look at both of our statements. So again, let us look at the scenario. We have Orange Company that started its business in 2019. That is the first year, and its financial year is 31st December. And then company made a sales of $1 million in the period. And then the year-end receivables are $200,000. All right. So if I look at my P&L, I should be looking at a sales of $1 million. And since there is no other income or expense, I can also call that my profit before tax, but that is not important. Let us focus on sales only. And then if we look at our balance sheet, we will see our receivables of $200,000. Now there are two facts that we know for sure. Number one, in this particular scenario, the cash received from customers is $800,000. Since 1 million is the sales, and you can see out of them 2 million are still receivable, then $800 is the total sales, total cash received from customers. And increase in receivables is $200,000. I am talking about increase in receivables, this particular term, because this is going to get very important in a moment. And you can see, since this is my first year of business, the opening receivables must be zero. And from 0 to 200,000, there is an increase of $200,000. Now we have to approach it a little systematically to make it easy for the scenarios when there is more data, and the business is not always the first year. There are opening values as well. So we have to learn a little bit of systematic approach to approach it easily next time. And that approach is, we will begin with the profit before tax from $1 million. Since in this case it is equivalent to sales, there is no problem, but in reality there will be much more data, but still we will begin from profit before tax. And then we will say, if there is any increase in receivables, please deduct that. If there is decrease, that would be the opposite side, that will be added back. So right now let us focus on the data, and the things will start to make sense to you. That profit before tax is $1 million, and if I deduct $200,000, I will be back at $800,000, which we all know is the cash received from customers in this particular case. Now this is a very simplified scenario where we only have sales, but in reality in the profit and loss statement there is cost of sales as well, and there are other expenses as well. So when all of that data comes together, things get quite complex, but this approach will remain the same. We will begin with the profit before tax, we will add back the decrease, or if there is increase we will deduct that, and we will assume that this working is automatically taking me to the right place, that is cash received from sales. So I hope that is making sense, and we are moving to more of the expenses of profit and loss statement in the next lecture. Let us work out the cash paid for the operational expenses. Now of course operational expenses can be seen in the profit and loss statement, but those expenses are recorded on accrual basis, which means that it is not necessary that the equivalent cash has also been paid. But one thing we know is, if the operational expenses are there and the cash has not been paid yet, that must be payable in the balance sheet. So we will be looking at both the profit and loss statement and the balance sheet. And we have the scenario, we just started the business in 2019 and our year end is 31st December. And in our profit and loss statement, we can see we have administration expenses of $100,000. Since these are expenses, this is a negative value, and there is no other income or expense in my profit and loss statement, which means that my profit before tax is also $100,000. You must be thinking that why I am focusing on profit before tax and not on any other profit like operating profit or net profit. Don't worry about that, you will see that in a few minutes when we go to the profit and loss cash flow statement format. Now let us take a look at the balance sheet as well, and in my balance sheet you can see there is a current liability for the other payables, that is $35,000. So since administration expenses are operational expenses, the payables that are related to these expenses are other payables. We are not talking about cost of sales at the moment, and the payables that are related to cost of sales are trade payables that we will be covering in the next lecture. Right now we are talking about the operational expenses, and the payables that are related to operational expenses are other payables. Right, so now let us take a look at some basic facts that we can see here. First of all, the increase in payables in my case, since I just started the business from zero, is $35,000. This is the increase, and the word increase is important for us. And then we also know that the cash paid to supplier in this case, since we have spent $100,000 and 35 is still payable, what we must have paid is $65,000, and since this is cash outflow, I have added a negative sign here just to reinforce that this is a cash outflow, money going out. Now let us just take a look at the format. So basically we have to, again I would repeat that, we have to approach this cash paid to suppliers systematically, because in a few moments the scenario is going to get a lot more complex. The profit and loss statement will not be so simple profit and loss statement. So we have to find a system to easily solve this. So we will begin from our profit before tax, and that is minus $100,000, and we will add back the increase in payables, that is $35,000. So since this is increase, we are adding it back, and now you can see if I net off these two values here, the net value is going to be $65,000 in negative. That is the cash outflow I already know. So now I just need to focus on one thing here, that is, when we were talking about increase in receivables, that was being deducted, that was negative, but the payables are opposite, so increase here will be a positive value. Why is that so? Let me explain you with the help of this scenario. So you can see we have spent $100,000 in expenses, and increase in payables basically shows that the money has this $35,000 has not outflown from the company yet. So since this is telling me that money has not gone, I am adding it back. I am from this 100,000 of negative value, I am adding it back. So it will take me to the right value of 65,000. So if you are not clear about this last concept that I have just said, please repeat this few minutes of video one more time and write it down, and then compare it with the receivables in the previous lecture, and you will, this thing will start to make sense to you, that since this was a negative value and money has not gone out yet, we have to add this value back. This is payables, right? So with that, we are done with our sales and operational expenses. In the next lecture, we are going to talk the next aspect of profit and loss statement, that is cost of sales, and that is going to be a little bit more tricky, but let's do that in the next lecture. Let us talk about the cash paid for the inventory purchases, and this is going to be a little bit tricky because we would find the inventory values in the balance sheet, but we also know that some of the inventory must have been sold as well. And for that inventory that has been sold, we can see the profit and loss statement, and in the profit and loss statement, this value will appear as the cost of sales. So again, we have to look at the profit and loss statement as well and the balance sheet as well. And one more thing, if you purchase the inventory and you haven't paid for that as well, for now, it will be appearing in the balance sheet as payables, and to be specific, trade payables. So we not only need to look at the profit and loss statement, cost of sales, but we also need to look at the balance sheet, and in the balance sheet we will be looking at the inventory as well as the payables, trade payables. So let us look at the profit and loss statement, and here you can see we have a cost of sales of $450,000, and this is profit before tax. And by the way, just to recall, this 2019 is our first year of business. And then if we talk about the balance sheet, here we have inventory in the current assets, that is $50,000, and then we also have trade payables in the liabilities part, which is $20,000. So if we just try to solve it here, we can say that you have $50,000 in inventory. It means you must have purchased that, and you also have sold for $50,000 of inventory. So it means that the total inventory purchased in the year must be $5 lakh, and out of that 5 lakh, 450 is here and 50,000 is here. Now if you purchase the inventory for $5 lakh, you must have paid for that as well, but we can see that $20,000 in that is still payable, which means that from the 500 you only paid 480. So I hope this thing is making sense to you, but now let us approach that systematically. First thing, we know cash paid to suppliers in this case is 480. We also know that the increase in inventory is $50,000, and we also know that increase in payables is $20,000 here, 50 and 20. And why we are saying increase? Because the opening values are 0. We just started this business in 2019. Now as I told you before, we have to approach it systematically. So we will begin from profit before tax, that is for $50,000, but we will then minus the increase, and if there is decrease in inventory, we will be adding that back. So I will be saying this is $50,000 in increase, and increase has to be deducted, and then we will be adding back the increase in payables, that is $20,000. So the rule is simple. For the assets, that can be inventory or receivables, the increase is deducted, and for the payables, the increase is a positive value. And now if we compile these values together, you can see 450 minus 50, that is 500,000 in negative, and then $20,000 in positive. That will bring you to 480,000 negative value that will present the cash outflow. Now with that, we are done with the basic workings, and now we will be going back towards the complete cash flow statement preparation. We have already seen the overview of the cash flow statement, and we discussed that the cash flows will be split into three different sections: operating, investing, and financing. And we then also represented all the cash flows that are going to be that are going to appear in each of these sections. Now with that, you can see we are almost ready. We can now extract all of these cash received and cash paid from P&L and balance sheet. But before we start preparing our cash flow statement in real, we have to do a little bit of formatting thing. We have to learn a little bit of formatting, and that formatting has to do specifically with the operating activities. In the operating activities, you can see that we are gonna say cash received from customers and suppliers, but accounting standards require us to present operating activities a little different to that. And what is that difference? Let me explain you. So we have seen this part of cash flow, that is operating activities, that begins with cash received from customer. But this method is called direct method, and there is an indirect method as well that is that is required by the standards to be followed on our cash flow statement. So rather than following this simple very easy method, we have to follow an indirect method, and that looks like this. Now why this is indirect method? Because here we are calculating cash flows indirectly from the profit and loss statement, and here you can see we are starting with the profit before tax, and then we are moving towards our cash from operating activities. Now I will explain you all of these items appearing in between in a minute, but I need to do that with reference to the example of profit and loss statement. But before I go there, I need to tell you a small thing, and if you don't understand that, please simply ignore that for now. As we will move forward, you will automatically learn that. And that thing is, if you are in the USA, you will be starting from net profit, but other countries start from profit before tax. So that is just a presentation difference that is required by different countries' standards. Now, by the way, there are only two standards broadly. One is in the USA, that is called US GAAP, and the other standard is IFRS, that is followed almost in all other countries. So not exactly in all other countries, but broadly speaking, you can say that. Now let us talk about this calculation that looks quite strange here, but if we approach it systematically, it will be very easy. And for that, let us move to our profit and loss statement. So here is an example profit and loss statement of a business, and we also have filled in some values here, and you can see we are starting from sales, deducting all of those expenses. We reached at profit before tax, and then we deducted tax as well, and then we reached at net profit. Now as we will start to prepare our cash flow statement, and I'm specifically talking about cash flows from operating activities under the indirect method, we will begin our workings, we will begin our presentation from profit before tax. And what we need to do is we need to reverse everything and go back to present our EBITDA value here in our cash flow statement on the face of our cash flow statement. And for that, we need to reverse everything that is being dealt here. So for example, when we were preparing our profit and loss statement, we deducted depreciation, we deducted amortization, we added interest income, and then the gain or loss on disposal was deducted, the exchange gain or loss was deducted, and then interest was deducted to reach at the profit before tax value. Now here we are going to reverse all of that. And for this, let us begin from interest expense systematically right from the bottom. So we added back interest, and then let us reverse the non-operating expenses and income as well that you can see here. So first of all, we have interest income that was positive in our P&L, so we are deducting it now. And then we have gain or loss on sale of asset, that is 5,000. Then we have exchange gain or loss, that is 15,000. So both of these were losses, so they were negative in P&L, but we have added them back now. And then after that, let us reverse these values as well, that is depreciation and amortization. And once we reach here, you can see, if I just focus on these values and if you just subtotal all of these values, the subtotal will be equivalent to $400,000. So we will be working on ibtida value to begin with for the next of the cash flow statement. Now, in case you are thinking that why we needed to do that, the simple answer is this is how the accounting standards require us to do, because anyone who is looking at cash flow statement, not necessarily the profit and loss statement is in his mind, so we need to give them a more brief view of what is happening. Now, once we reach at this value, what we need to do next is we need to handle the working capital changes. What these are, ignore the word working capital, you are going to learn that very soon. But for now, let us focus on these values of receivables, inventory and payables. And what we are doing here, let me explain you. So what we are trying to achieve with all of these three values. So once you have reached at this ibtida value, remember only this part of P&L is left to be handled. And in this part of P&L you have sales, you have cost of sales, which means that you have spoken about inventory and the purchases as well. And then you have operational expenses. Now, if you haven't received the money from sales, that is going to receivables. If you haven't paid the money on expenses, that is going to payables. And if you haven't sold the inventory that is also in the in the inventory part on the balance sheet. So this part of the P&L can easily be converted to cash by handling the receivables, inventory and payables, and we have seen that individually one by one in the earlier examples. And once we have done that, once we have dealt with all of these three values, we would say that we have fully converted our profit and loss statement into the cash flow. So I repeat, first of all, we reversed everything to reach at this point, and then we reversed this part from accrual to cash by dealing with the receivables, inventory and payables. And finally, now one last thing that is remaining here is interest received and taxes paid. So interest paid and taxes paid. So we will be handling the interest paid and tax paid. And once you have done that, you will be reaching at net cash flow from operating activities. So why we are describing that separately? There is a reason for that. So basically we say the interest payment and tax payment has less to do with our operations and more to do with the country, the tax rates of the country, and more to do with the way company is financed. So if the company is debt financed, the interest is going to be higher. So that is natural. So we are less focused on this part, but so we are less focused on this part here. So these are presented separately so that we are specifically focusing on the cash generated from operations. So I hope this all is now making sense to you, and with this we are now fully prepared to start preparing our cash flow statement. Get excited, that is very interesting part, and let us do that from the next lecture. So we have already seen how the cash flow statement is split into three sections, and then we also discussed that what is the format of the cash flow statement. So after the company title and the report heading, we begin with the cash and cash equivalents at the beginning. Then we present the cash flows from operating activities, then from investing, then from financing, and finally we add operating, investing and financing to reach at net cash generated in the year. And then finally we reach at by adding the opening cash with net cash generated in the year, we reach at cash and cash equivalents at the end of the year. Now definitely this is just an overview, and we also need to show you the split of operating, investing and financing activities. So what is looking very simple right now actually becomes a very comprehensive and detailed report that looks like this. So we have company name, report title and the period title, and then it begins with cash and cash equivalents at the beginning. Then we have all the cash flows from operating activities, and all the line items that we have discussed are presenting on the face of cash flow statement. So this section of operating activities is so brief that you are seeing on your screen right now. Then we also present the cash flows from investing activities with all the details that we have. And then finally we also have cash flows from financing activities, and these are presented with all these details. Then after presenting all of these three sections, we calculate the net cash generated in the year, and then we add the net cash generated in the year to the opening cash to reach end cash and cash equivalents at the end of the year. So I will also be sharing the screenshot. I will also be sharing this slide with you for the download in this lecture. Please download that, and this will be very helpful. If you have this format in your mind, your next workings will be very handy. So let us do the complete preparation of cash flow statement from the next lecture. Welcome back. So we are finally here. We are going to prepare a complete cash flow statement in this lecture. On the left side, you have the same profit and loss statement and the balance sheet that you have prepared earlier in this course yourself. And now here we are going to prepare cash flow statement from these values of profit and loss statement and the balance sheet, and we do not need to look at any other data or even at the trial balance. These two statements, P&L and balance sheet, are sufficient for us. Now I will be preparing the cash flow statement twice for you. First I will do it simply, theoretically putting in all the values, and then I will come back again and prepare the cash flow statement using Excel intelligently. If you did not notice, this screen that is open in front of me right now on your screen is Microsoft Excel. Just that this is a little beautiful interface. So if I can show you, this is just a Microsoft Excel. Okay, so what we need to do is we need to begin from the top, and that is cash and cash equivalents at the start of the year. And since 2019 was our first year of business, if you remember the scenario, the cash and cash equivalents at the start are going to be 0. And then let us talk about reversing all of this part in the profit and loss statement. So we told you that we begin from profit before tax and we go all the way back to EBITDA value, right? So we have to start from here, that is profit before tax, and this value is 379,000. I'm sorry, 379,000. Then we have to add back interest expense, that is $10,000, and since this value is negative here, I have to add that back and make it value positive. Then dividend income here is $3,000 positive here, so I'll make it negative. By the way, if you are thinking that why I'm simply putting in the values, I can use Excel properly, intelligently, I will do that separately for you. Right now I want to make sure that your focus is just completing the cash flow statement concepts. And then we have interest income, that is $6,000, so I'm gonna say minus $6,000 because this value is positive, I'm making it negative. Then depreciation and amortization is $20,000 negative, I'll make it positive. Then $100,000 positive, I'll make it negative. With that we have reversed all these values, and if I just sum the values for you just to show you, the total here should be the same as EBITDA value. So you can see that my values have now reached at EBITDA value. So we are done with this. I will delete this subtotal here, we don't need that. Then we need to present the working capital changes, which are basically related to inventory, receivables and payables. Skip the word working capital for now, you will be learning later on in this course. So inventory at the beginning, of course this is the first year, it must be 0. So from 0 to $40,000 inventory has increased to $40,000, and increase in inventory is a negative value. Listen, if you are increasing the inventory means the money is going in, the cash is negative. So same for receivables. So receivables have increased, I would say that minus $30,000, I'm seeing it here. Receivables have increased to $30,000, I will say $30,000 here, but since it is an increase, I would say it is negative. And for payables, of course we have to consider all the receivables and all the payables. Here the trade payables and other payables are split separately on my balance sheet, but we have to combine them. So 25 plus 15, this will be $40,000, and the payables have increased. Increase in payables is a positive value. So we are done with that as well. Now we have to calculate a subtotal here, that is cash generated from operations, and for that I will sum all of these values. Make sure that opening cash is not included, of course, and sum all of them. And I'm sorry, let me do that again. So summing together all these values, close the bracket, and here we go. So cash generated from operations is $470,000. Now we have to talk about interest paid and tax paid. Let us talk about tax paid first. It is simple. So tax, you can see in my profit and loss statement, is $79,590. And this is the first year of business, and you can see that all the tax is $79,590 is still payable in my balance sheet, which means that you haven't paid anything at all in the taxes in this year. So tax paid is going to become 0. And if we talk about interest paid, you can see in my profit and loss statement that my tax expense is $10,000, and on the other hand, if you talk about interest payable, that is $4,000. So it means that, out of the $10,000, you have already paid 4,000. I'm sorry, the 4,000 is still payable, which means that the remaining has been paid, which is $6,000. So I'll take that, and since the money is going out, interest is getting paid, this will be a negative value, and tax is 0, so we don't need to worry about positive or negative. And now we can calculate cash flows from operating activities total value, and that is going to be sum of this value, that is taxes, plus interest, plus this cash generated from operations. Because we have already compiled all these values here in 470, we just need to add that. And now we have reached at cash flows from operating activities, that is 464,000. Let us talk about the cash flows from investing activities now, and let us begin with purchase of non-current assets. Now if you look at my balance sheet value of property, plant, equipment is 400,000, and there is nothing at the beginning. This is my first year, which means that we must have purchased the assets of 400,000. But yet, wait, there is also a depreciation of 100,000, which means that the assets you purchased, they got depreciated by 100 and they are still at 400, which means that the original value of the asset are going to be, that were purchased, is going to be 5 lakhs. Similarly, for intangible assets, the value of is 80,000 here after the amortization of 20,000, which means that from 0 you are at 80 after amortizing by 20, which means that the assets purchased must be a value of $1 lakh. Now let us talk about my investments. So if you look at my balance sheet here on the top side, my investments are $50,000, which means that we must have invested $50,000. So this is going to be $50,000. And by the way, I'm so sorry, this purchase is going to be a negative value because it must be cash outflow. Similarly, it must be cash outflow, and this investment is also cash outflow. Now let us talk about dividend income received. Now here is the dividend income, that is $3,000. And this is income, this is profit and loss statement. It doesn't mean you also receive that. But if you didn't receive, it must be receivable in the balance sheet. So my P&L says my dividend income is 3,000, and from that 3,000 my receivable is 1,800, which means that I must have received 1,200. So since it is received, the money is coming in. This is a positive value of 1,200. Similar discussion for interest. My profit and loss statement says I earned interest of $6,000, but did I also receive that? Well, if I didn't, it must be in the balance sheet in the receivable part, and you can see here that my interest receivable is 2,000. So from 6,000, 2,000 is still receivable, which means that I must have received $4,000. And again, since it is money coming in, the cash flows, are going to be positive. And finally, let us all of these add together all these values to reach at the sum of investing activities. Good job. So now let us talk about financing activities. And here we have to say proceeds from the issue of share capital. And for that, I will have to look at this part of share capital and share premium. Even I use the word share capital, I should be using the word issue of shares. That is better. And in that case, I would say we are talking about share capital and share premium, both of them. The first year of business, the opening balances were 0, and yet you can see that share capital and premium combined, you are at 150,000. So you must have received the money from shareholders, that is 150,000. Then let us talk about long-term borrowings as well. From 0, you are at $200,000 bank loan, which means that you must have received this money. So again, a positive value of $200,000. And then let us sum together both the financing activities, and here you have a value of $350,000. Right. So with that, now we are ready to calculate this value, that is cash generated between the year, and this should be sum of operating plus sum of investing plus sum of financing, and my cash generated in the year is 162,000. Finally, we have to reach at cash and cash equivalents at the end of the year. So I would say previous value that we have, that is cash generated in the year, plus the opening value that is on the top of my value. Here it is, cash and cash equivalents at this start. And once you do that, you can see my cash and cash equivalents at the end of the year are 169,000. Now the question is everything correct here? And there is a very simple answer. My cash and cash equivalents value was also available in the balance sheet, and you can see it here. Cash and cash equivalents 169,200, and you have the same value that you have calculated here in the cash flow statement. So we can almost assume that everything here is absolutely correct, and that is why these two values have matched to each other. So we have prepared our cash flow statement very easily. I hope that everything is clear to you, but we are going to do that again in the next lecture. This time I will be using Excel more intelligently, and that is very important. Please do not skip this lecture. That is very important that we properly use Excel, because practically we have to prepare cash flow for multiple years, and to be hands-on with Excel, that is very, very important. So I'll see you again in the next lecture. By the way, you can download these resource files and practice on your own as well. Welcome back. So we are going to prepare the cash flow statement again, but this time we will not be hard coding any value. I will not be writing any number like that. Rather, I will be linking the cells so that we can utilize Excel to our benefit, and for the future years we can simply copy paste the values to prepare a cash flow statement. Don't worry if you did not get this point. Let us start working, and the things will start to make sense to you. So for example, here cash and cash equivalents at the start of the year. I can simply write 0 because this is my first year and I know the balance is 0. I can do that. But rather than hard coding it this way, writing a number this way, I will link it to the cell, and you can see cash and cash equivalents. This is the year end value. I have to pick the beginning value, and the beginning value should be the previous year value. But here in my case there is no previous year. No problem. Just link it to this blank column here, and this will pick the 0 value. Now these blank columns serve two purposes. First of all, they are good for presentation. They beautifully separate different statements. Secondly, we can use them for this purpose as well, that when we have to pick the 0 numbers, we can do that. Now this is beneficial for me because when I will go to the next year preparation, I will copy paste the formula and system will automatically pick the values for me. You will see that, don't worry. Okay, now after that we have to move to profit before tax, and for profit before tax I will link it to my profit and loss statement. Here this is my profit before tax value, so I will say equals this cell, and this will pick my value of profit before tax. Now for the interest expense, I need to present the value here, but I just don't need to write the value of 10,000. I also need to make sure I'm reversing the sign. So this value is negative here, it should become positive here. So I will say equal minus, and with this minus and this value minus automatically becomes minus will become positive value. So by adding a minus sign, I have made sure that the negative value of P&L is now appearing as a positive value. Next we have dividend income, again equals and then minus sign to change the original sign, and then dividend income here is 3,000. Similarly for interest income, again a minus sign and then going back here, and you can see both of these values have been presented here with opposite sign. Same goes for the amortization, equals minus this value and equals minus depreciation, and here you have reversed your profit and loss statement. So if I can just quickly sum and check if these values are correct, yes these are, because this is 500,000 EBITDA value. Right, now we have to talk about inventory, and this is where it gets a little technical. Now of course you can say equals inventory value of 40,000. It will serve the purpose for this particular example, but this is not going to be the way we are going to do that, and this is because we have to find the increase in inventory, and with increase we mean that the change. So I would say this year value minus the previous year value, so that we can say the change should be reflected here. So I would say equals this cell minus this cell, and you can see that this is $40,000 here in inventory. But now here is a catch. The increase in inventory, the increase in assets has to be presented as a negative value. So I have to use this Excel plus minus intelligently, and I would say equals this cell and then minus this cell, so that increase becomes negative value, and now you can see that you have minus $40,000. Similarly for receivables, I will say equals previous year receivable minus the new year receivable, and that becomes the increase in receivables, and that becomes a negative value. Now for payables, we have to pick all the payables. Of course for the receivables as well we have to pick trade and other, but good for us that in receivables there were only one type of receivable, and that was trade receivable. But in payables we have trade and other, we have to pick both of them. So rather than simply picking up the value, I would say equals sum of these two values, close the bracket to close the sum, minus sum of previous year both values, and close the bracket, and that's it. So increase in payables have to be a positive value, and this is a positive value. So for payables what we have done is we have set this value minus previous value, but for receivables we set this minus this, right? So we worked a little intelligently to make sure that our end result is presented in the way we want. I hope you got this point. Right, so now let us talk about interest paid, and this is where it gets a little more tricky, because now we have to show the calculations where P&L is involved as well as balance sheet is involved. So a little bit more tricky, and tax paid is going to be easier in this example, so I'm going to begin with tax and then I will come to interest paid. Now for the tax paid, please take a look at the profit and loss statement. This is tax expense, and tax expense for the year as seen as in the P&L is 79,590. Now look at the balance sheet. All the 79,590 is still payable. So my first year of business, whatever is my tax expense in my P&L is still payable, which means that I haven't paid anything at all in my taxes. Of course you can write 0 here, but a better practice is to link the Excel formula, and for that I would say this expense value plus the payable tax payable. Now you got the 0, but eventually getting 0 is not important. Understanding the concept and linking the cells is even more important. So I will do it this way. So I would say that tax paid equals the opening tax payable, whatever the previous liability was, plus the new tax liability. Now the problem is this value is already in negative, and if I say plus, this will plus minus become minus, right? So this will not serve my purpose. So intentionally I'm going to use this negative sign here. So I would say opening tax liability minus this. So basically this minus minus is to make it plus. So now the situation is opening tax liability plus the new tax liability minus any tax that is still payable. So I will do that and the answer will become 0. So since this value was minus, we did use a minus sign here. Otherwise technically I'm doing the plus, and the logic is very simple. Opening liability plus the new expenses, that becomes the total liability, and then you deduct what you have not paid here. So press enter and the answer is 0. Now let us talk about the value of interest payment. And again, this is going to be a little bit tricky but very interesting. The interest payment, how do we calculate that? It is simply opening an interest liability plus all the interest expense in the year, that becomes the total liability, minus the liability that is still pending at the end of the year. So I would say equals opening an interest liability, that is here, plus the interest expense. Now the problem is this value of interest is in negative, and if I add plus, plus minus will become a minus. So my technique will not work. So I would rather use a minus sign, so that this minus sign and this value minus sign, minus minus, become positive, and the value becomes a total value. And then I will deduct the closing value of interest, and if I press enter, this value has become my interest payment value, $6,000. But now here is one problem, and that problem is I want to reflect this value on my cash flow statement as a negative value because the money is going out. So what I'm gonna do is, rather than trying to change my formula, the formula that I understand, rather than trying to change that, what I will do is I will press F2 on my keyboard and the formula opens again, and I will use the brackets, and for that brackets I would say come here, add an opening bracket as well, go back, and then multiply the whole value with -1. So my calculation will remain the same, but when the answer comes, that will be multiplied with -1, which means that just the the sign of that number will change. So I'll press enter, and this value is now $6,000 in negative. And by the way, I need to do that again for taxes as well. I just did not explain that at that point because there were no numbers to explain that, but I will just do it for you now. And now my formula is something that I can copy paste. So that is it. We have calculated the interest paid and tax paid as well. If you did not understand that, please repeat it few times before moving forward with the video, because it is going to get even more complex in the next part. But now we are done with this, so let us move to the next part, and that is cash flows from investing activities. And let us begin with purchase of non-current assets. So how would we find the purchase of non-current assets? Let us talk about that. First of all, whatever is in the property, plant, equipment, you must have purchased that, of course, right? And then plus depreciation. Depreciation has to be added back because when you purchase the asset, it was not depreciated. We have to add that back as well. But now again the problem is depreciation value is in negative, so plus minus will become minus. So again I have to go back and change the sign to a negative value. And if I just stop here just to show you, this will become 500,000, right? But now we know that if there was an opening balance in the balance sheet, you must not have purchased those assets, right? So whatever was already available must be deducted from here. So I will deduct the opening value of the fixed assets. Since it is 0, my answer will again become the same. Now again the same point I got to repeat here, and that is, since we are purchasing, in the purchase the cash flow has to be an outflow. So I will use the same technique. I will go here, press, add brackets, and then multiply the whole value with -1 to make this value a negative value. I again repeat, by you could simply get the answer in negative by doing things here, and you did not need to use a logic, and you did not finally need to multiply with -1. But doing an illogical work will not explain you anything. You may get the answer, but the technique will not be error free, right? So now let us move to purchase of intangible assets, and this time we can quickly work with this. So I would say equals intangible assets that are available in my balance sheet, and then minus this amortization, so that this minus minus become plus, and we will say that we must have purchased the intangible assets of $100,000, but if there was an opening balance, that must be deducted, that must not be purchased. And finally, let us use the brackets to put everything into the negative value, multiply with -1, and here we go. So we are done. Now for the non-current assets and intangible assets, we had to work with both P&L and balance sheet. But for the investments, investments only fall in the balance sheet, it never goes to the P&L, so we don't need to worry about that. I would say equals this value minus this value. So whatever is my investment here, 50,000 is the cash outflow, definitely. But if there was opening value, that must not be cash paid this year, so I will deduct that, and this answer is 50,000. But again, there is an investment of $50,000, means that you must have paid cash for that, so this value should have been a negative value. And this time, rather than multiplying that with -1, I can simply change the order of the formula. Since this is a very simple formula, this technique will simply work, and the answer will become a negative value. So the point is very simple. This minus this, that will simply tell you how much change has occurred in this year. Now let us talk about dividend income received and interest income received. And since we have done very similar working here in interest paid, I would say that please pause the video and try this first yourself. And when you are done, come back. Now let us resume. So for the dividend income received, I would say that first of all, whatever was my opening receivable from the last year plus whatever is my dividend income, all of that becomes my receivable. I repeat, opening plus income. And then what I have not received is definitely whatever is lying in the closing balance. So I have received $1,200, and you can see this is already a positive value. We have received the money, and this is $1,200 positive value. So this value is actually very easy to understand and explain in comparison to the previous ones. Let us do the same thing in the interest received. So we have the interest receivable of opening, whatever that is, plus the interest income, that is $6,000. That becomes my total receivable, and what is not received is that whichever is falling in the closing balance here in the interest receivable. So I have received $4,000 here, and with that we are ready to calculate our sum of investing activities, and here you go. Now this is the total of investing activities. Now let us talk about the financing activities. So I will scroll down, and let us begin with proceeds from the issue of shares. Now this time we only have to look at the balance sheet, because these financing has nothing to do with the profit and loss statement. So proceed from the issue of shares, I would say equals, by the way, you can see we have $150,000, but we have to see that the previous year should be excluded. If there was opening balance, that is not our receiving. So I would say equals sum of these two values minus sum of opening balance, and that is here these two values, close the bracket, and here you go. $150,000 received in positive value, received in your financing activities. Then similarly for long-term borrowings equals, there is only one value, so this value minus opening values, and that becomes your 200,000 positive value. Let us sum these two values together, and now we have to reach at cash generated between the year, which is sum of financing plus investing plus operating. Okay, we don't have done the total here, so I will just use this blank cell and I will go back and do the sum first. So I'll press enter for now and go back, and I would say first of all we should be generating cash generated from operations, which should be this value here, equals sum of all of these values beginning from profit before tax. And then we have to reach at cash flows from operating activities total, which is sum of this plus this plus this, and that becomes 464,000, and my cash generated between the year becomes 169,200. And finally cash and cash equivalents at the end equals this value that is generated between the year plus the opening value that is up there, and that value is 0. Press enter. So my closing value is 169,200, and by the way the same value is here in the balance sheet. So I hope that you have found preparing my cash flow statement with Microsoft Excel very interesting, and you will start to notice the benefits when we will be adding 2-3 years of data here. You will really enjoy that the effort that you have done here in preparing 1 year will make it totally easy for the second, third, and whatever year is coming then on. So with that we are done with the basics, and there's a lot more to go. Let us do that. Let us start a new exercise in the next lecture. Welcome back. So now that we know how to prepare cash flow statement, we are now ready to prepare the cash flow statement for the next year of business, that is December 2020. By the way, now you can see I have the comparative figures for the last year available as well, and this is because to prepare the cash flow statement we would need the comparative values from the previous years, because in a lot of different things we need to take the comparative values like change in inventory, etc., and that is why we need the previous year values as well. The last year that we were working on was the first year, so there were no comparative values anyway. Now you may like to pause this video and you may like to solve this yourself first before coming back to check the answers, but now we are going to solve it anyway. By the way, since we worked very intelligently and we linked the formulas with the previous cell even in 2019, you may like to copy this, all the values, and you may like to paste that here, and once you do that your cash flow statement should be automatically prepared for the next year. So I'll show you this as well, but then I will take time and I will prepare the cash flow statement right from scratch, so that if anyone is not confident, he still gets the explanations he want. By the way, you may like to, if you are already done with this and your cash flow statement is tired, you may like to skip the remaining part of the lecture. Now let me copy paste the values here, copy and paste, and once I do that you can see my cash flow statement has been prepared. The closing cash has become opening cash, and all the values are here, and my closing cash and cash equivalents have been calculated as 877,210, and this is exactly the cash that I can see in my balance sheet. So my cash flow statement is already prepared within a minute, but now I will delete these values and I will prepare them right from scratch so that you can get the explanation one more time. But if you are done, if your questions are already answered, please skip the remaining part of the lecture. Now let us begin from scratch. So cash and cash equivalents at the start of the year are coming from the previous year. So I would say at the beginning is the ending of previous year. So we are in year December 2020, and the opening value would be the closing value of last year, so I'm gonna pick this value. Now let us talk about profit before tax, and for that I got to go to my profit and loss statement here, and that is profit before tax, this value. And now let us pick up the interest expense, but please do not forget to change the sign. So I'll add a minus sign here and I'll say this is my interest expense, so it is getting added back here. And then same for dividend income, change sign, and here we go. Same for interest income, change sign, and here is my interest income. And amortization, change sign, and this is the value. And then depreciation, this is my value. So now you can see that we have correctly calculated all of these values. And just to check, I'm going to calculate the subtotal, that if my values are correct. And once I do that, you can see my subtotal here is 748, which is my EBITDA value. So I can confidently say that I have reversed my profit and loss statement up to this point. So this subtotal is not needed. I'm gonna delete that. Now let us talk about inventory, receivables and payables. Now the rule is, if the inventory is increased, it is going to be the negative value. So I'm gonna go to inventory values here. Here is my inventory, and the increase has to be negative. So I will say this value minus this value. Yes, there is the increase that is going to be calculated, and the answer is gonna be negative. And yes, inventory increase answer should be negative. Let us do the same for receivables as well. This value for receivables minus this value, and that got me to 55,000 in negative value. Now let us talk about payables as well. But for payables, you can see we have trade as well as other payables as well. So let us include both of them, and I'm gonna say sum of these values minus sum of the previous values. So the increase will become the positive value here. If there is an increase, that will become the positive value, and you can see this is the positive value. Yes, increase in payables have to be reported here as a positive value. Done. Now let us talk about interest paid. So if the interest is getting paid, it has to be negative value. But first, let us say how the interest has to be calculated. Interest payment has to be calculated logically. And I would say my interest payment should be, first of all, I should take the opening liability of interest. Then I should plus. Now I would do the minus instead, because this value of interest is already in negative. Minus will automatically become the plus. So I would say that previous payable plus the interest expense, that becomes my total payable. And then please deduct the closing liability, because we haven't paid that yet. And once I do that, that should calculate my interest payment. I will change the sign in a minute. Just a moment, let me explain that. So what we are saying here is that our opening liability of interest was 4,000, and then there is an additional liability of 15,000 in the year. Total liability becomes 19,000. Out of that 19, 10,000 is still pending, which means that the remaining 9,000 have been paid. And finally, since this is payment, I got to change the sign. So I'll multiply that with -1, and that changes my sign. Now let us talk about tax paid as well, and same logic. So my tax paid should be the opening tax payable plus the new tax expense, that is here. But since this value is already negative, I'll rather do minus, and minus will automatically become the plus. And then what is not paid is already in liability, so please deduct that, and that gives me my tax paid for the year. And of course we need to change the sign as well, so multiply that with -1, and that gives me cash flow from operating activities total. But first we wanted to calculate a total here as well, that is cash generated from operations. I'll do sum of all of these values. Please make sure the opening cash balance is not included here, and then let us do the sum of these three values. So here we have cash flow from operating activities total, and I hope that you have found that very straightforward. Now let us talk about the purchase of non-current assets, that is investing activities. So if we have purchased the non-current assets, our balance sheet value should be increased. So what I would say is, please pick up the closing value of the non-current assets, that is this one, and reverse the depreciation as well, because if we are talking about the original value, depreciation reduction should be ignored. So I will say plus depreciation. Now the problem is, if I do the plus, this value is in minus, this minus plus will become minus, so I'll rather do minus, and by doing that I will be reversing the depreciation. And if I can just show you, that is 500,000, right? And from this 500,000 we need to remove the opening balance, because that cash, that non-current assets were already there, we haven't purchased that in this year. So I'll remove the previous non-current assets, and that gives me $100,000. So let me repeat the whole process. At the end of the year we have 380, and with the reversal of depreciation we actually had, if we ignore this depreciation thing, we actually had 500,000. At the beginning we had 4, so 4 to 5, that becomes 100,000. And of course we got to change the signs here, so bracket and multiply that with -1. The same concept on intangible assets. So at the end of the period we have intangibles of 60,000, and we're gonna plus the amortization, minus minus becomes plus, so this becomes, at the end of year we should have 80,000, but the opening is also 80,000, so it means that, you know, we do not have any purchase of intangible here anyway. So my answer is all right already, but since, you know, we usually copy paste the formulas to future, so we want to write a formula that is applicable in all cases. So I'm gonna multiply that with -1 anyway here, and I will repeat the reason. We may copy paste the formula to the next year, and if there are, you know, purchases, that should become negative automatically. So I'll make sure that in case of purchase the answer becomes negative. Now let us talk about the investments. So in the investments you can see we have $80,000, but the beginning value was 50,000, so I'll deduct the 50,000 and the answer becomes 30,000. But since the investment is increasing from 50 to 80, the additional investment has been made, there must be a cash outflow, so I should rather do it this way, 50,000 minus 80,000, and that gives me the minus value. If you like to do that in the previous way, this value minus this value, multiply by -1, that is okay, there is no problem as well. Let us talk about dividend income received. So in your balance sheet you can see you have a dividend receivable of 1800 at the beginning, plus you earned the additional dividend income, that is 12,000. So actually I would say that you should receive 1800 plus 12,000, right? But at the end you can see you still have 7,000 in receivable, so you must not have received that, so I'm gonna deduct it, and this value is $6,800 positive. You have received a dividend, so the answer should be positive. Let us talk about interest as well, the same thing. So at the beginning we have interest receivable of 2,000, plus we have earned the income of 15,000, that makes me that I should be receiving 17,000. But then you can see that you still have 5,000 in the receivable part, which means that you haven't received that money, you only have received $12,000. Now done with this, let us sum all of these values, and you can see that our cash flows from investing activities are now 111,200 negative. Now let us move to the cash flows from financing activities, and for that, first let us calculate the proceeds of issuance of share capital. So it can be simple, we can see that here, that we have increase of $50,000 in share capital and increase of $60,000 in share premium. So that should be combined together in my cash flow statement, and I would say that to calculate the increase, calculate the sum of these two, and from that sum deduct the sum of previous balances. And once you have done that, you can see your increase is 110,000, and that is a positive value. Now let us talk about proceeds from long-term borrowings, and that can be seen here, the bank loan, non-current liabilities, and that would be again this value minus the previous year value. So this becomes 100,000 increase, and with that we can now also calculate the total of these two. That should be the cash flows from financing activities total. So now that we have cash flows from operating, investing and financing activities, we can calculate the cash generated between the year, which is sum of financing plus investing plus operating activities, and that get to be 708,101. And finally, to calculate the cash and cash equivalents at the end of the year, I will go to the opening cash and I'll add the cash generated in the year, and that gets me to the value of 877,210. And we can check in the balance sheet we have same value, so that shows everything has been done completely right. So with that we are done with our cash flow statement for year 2020, and now you will have the assignment where you will be preparing the cash flow statement for the next year, that is 2021. I'll see you there. So here you have the profit and loss statement and the balance sheet for fiscal year 2021, and of course the previous year's data is also available. All you need to do is to prepare the cash flow statement for fiscal year 2021, and once you do that you will have the answers to check, and also you will have the complete solutions video explaining everything. Welcome back. So let us start preparing our cash flow statement for year 2021, and for that first of all I will scroll to the right, and the easy way of doing that would be simply to copy the previous year financial cash flow statement and paste that. And once you do it, you can see that your balance at the end of the year is equal to the balance cash and cash equivalents balance in your balance sheet. So we are done with the preparation of cash flow statement. But if you are still not confident, I am going to solve it again for you. And if you have already done that, if you are already clear with your concepts, you don't have to watch it, you can skip the video right here. Now let us delete this and prepare the cash flow statement from scratch one more time. So let us begin with cash and cash equivalents at the beginning of the year, and you know that this is cash and cash equivalents value at the end of last year. That is going to be the beginning value for this year. And now profit before tax is coming from the profit and loss statement, and if I can see, I will have to scroll a little to the right. So this is the right value of profit before tax. Let us talk about interest expense with the sign change, and similarly dividend income with the change of sign, and then interest income, and then amortization, and then depreciation. And let us check the values up till this point. That is just a step that we do for our own check, and you can see that my value here is 1020000, which is equivalent to this one. So I'll delete this value, I don't need that. Now let us talk about increase in inventory, and we also know that the increase in inventory should be the negative value. So I'll do this value minus this value. This will calculate the change in inventory, and increase will become negative. Similarly for receivables, this value minus this value, and similarly for payables, but there are two payables, so I will do sum of these two values minus sum of these two values, so 65,000. And you know, in case of increase in payable, that has to be positive, hence this is a positive value. Now for interest paid, I would say pick up the interest payable value from my balance sheet, that is interest payable at the beginning of the year, minus the interest expense, that is actually the plus, we have discussed that, minus minus becomes plus, and then minus the balance that is still payable. You get the value, and then we make it negative by using this formula, whole bracket minus 1 multiply, done. And tax paid, that is opening payable minus the expense for the year, minus becomes plus, so it is basically plus for the year, minus balance that is still payable, and then let us convert the value to the negative one, and you got it. Now let us talk about purchase of non-current assets. So I would say whatever is the non-current assets available right now minus depreciation. So this is again a plus, minus will become plus, so we are reversing the depreciation, and then we need to deduct whatever was already available here, and of course it has become 0, but we have a best practice that we always make sure that the value is, the formula is complete. So I'll make it -1 so that in case the answer is there is some value, the increase becomes negative. And similarly for intangible assets, I'm gonna say this value minus amortization, that is actually plus, and minus the opening value, and again just for best practice I'm gonna wrap this around and multiply that with -1. Investments, that is this value here, so I will say investments from 80 to 10,000, so I will say this value minus this value, and this has become a positive value, and that should actually be positive. The reason is, if your investments are falling, it means that you have sold your investments, and there must be cash inflow from that. And now let us talk about dividend income received. So for the dividend income, I'm gonna say previous dividend receivable plus the new dividend income minus what is still receivable. Same for interest, previous receivable balance of interest plus the new income minus something that is still receivable, so this value here, and with that we can now calculate the sum of all of these values, and that will be the sum of investing activities, total cash generated from investing activities. And then we have financing activities, so I'm gonna say equals sum of cash, share capital and share premium, new one, minus the sum of old one. So if there is increase, that will become positive, and you can see that we have $140,000 positive value, that is cash inflow. And now let us talk about bank loan, that is this value minus previous value, and that is cash flow from long-term borrowings. And now we can do the sum of these two, and that is 210. And now we can do the cash generated between the year, but before that I just need to do the totals here as well, I forgot that. So I'll say cash generated from operations are all of these values combined together, and then cash flow from operating activities total are these three values combined together. And now cash generated between the year is operating plus investing plus financing, and then cash and cash equivalents at the end of the year are opening cash plus the cash generated in the year, that is 1,972,300, and that is exactly matched with my balance sheet, so I can safely assume that my workings are correct. I hope you are now quite confident with the preparation of cash flow statement.